So that's important as we get towards the end of the day, towards the US trading day, and the German 2-year echoing what we've seen over in the United States then, Tom.
So we particularly look for those rate-sensitive sectors when trading begins. DAX futures, UK futures, across the board, you're looking to gains of around 1% in the session today, Anna.
Okay, so we are looking for some gains then, looking for European equity markets to catch up with US counterparts of yesterday, to focus in on the Fed. We know we're going to hear from the ECB and from the Bank of England. How does what we've heard from the Fed influence the extent to which they want to push back against pricing of cuts in markets? And we've seen that pricing of cuts in markets here in Europe increasing since we heard from the Fed. So how much has that made it easier or more difficult for the central banks here in Europe? That'll be a conversation that runs and runs. This is the equity market picture then. As we've been pointing out then, Tom, we were expecting to see some strength post-Fed, and we've seen that. The Spanish IBEX up by 1.4%. The French CAC 40 up by 1.3%. It's pretty broad-based. A lot of equity markets going higher. Here's a continuation of yesterday's trend on the dollar then. Lower yields, lower dollar, and that takes care of the FX column, essentially. Pretty flat, actually, on the pound and the euro. The yen, perhaps, catching more of the other side of that dollar trade. This is interesting on sovereign bonds. All the way through the Asia session, we've seen this column lit up very bright green, indicating the outsized moves that we're seeing through the Asian session in sovereign debt in the Asian region. So this isn't just a US story or a US and European story. This is certainly a global one. We saw yields coming down through the Asia session, and now we see that trend into Europe as well. Yields coming down in the German 2-year, the Italian 2-year, the Spanish 2-year, and there's the start of the gilt trade. So the 2-year UK down by 12 basis points this morning, nearly 13, and commodities catch a bid just a little. 74.79 is where we trade on Brent crude this morning. Tom.
Just one sector across the 12 main sectors that we focus on at the start of trade that is in negative territory. That is insurance, down 0.1%. But move away from that because the interest really is in those rate-sensitive areas. And again, the basic resources story that I flagged for you at the start of the show, and you're seeing that sector smashing with the gains there. 2.6% is the upside coming through from basic resources, and that is helping to lift the FTSE 100. But tech is also a big play. As we see those yields drop across the curve, tech as a sector, we know it's sensitive to those moves, gaining 1.5%. Autos also, of course, linking to the rates environment, gains of 0.7%. Banks doing well. Financial services, gains of 1.6%. The industrials are lifting up 1.4%. Food, the consumer sector. Look at those consumer sector stocks coming up as well. Gains of more than 2% there. Ignore the DAX. This is not reflecting the pricing of the day. Across the benchmark, gains of 1.13%. 477 now on your European benchmark as the FTSE 100 sits comfortably above that 7,600 level, gaining 1.2%. Anna.
Okay, yeah, the DAX not yet open, but other markets, as you rightly point out, very strong this morning post the Fed. Sophia Horta-Acosta joins us from the Markets Today blog to talk us through the stories being covered there. And we've talked about the Fed, Sophia, and of course that sets the stage for the ECB and the Bank of England today. The Bank of England, most people were thinking, they're going to want to push back on the market pricing, but the market pricing just keeps getting more and more negative. The market increasingly pricing in cuts for next year.
Yes, exactly. And that's the difficulty with the BOE not actually having anything like the dot plot that the Fed has, because it historically has been reluctant to kind of indicate too strongly where it thinks rates might go, lest the market or the public thinks that that's a hard kind of promise of policy. But right now you're seeing this enormous disconnect between what markets are thinking, which is 5 interest rate cuts from the BOE next year, and what Andrew Bailey and his team have been telling the market, which is it's far too early to even start thinking, let alone discussing interest rate cuts. So you're seeing that disconnect. Today we're not getting a press conference from Andrew Bailey and his team, so we're only getting the decision and minutes from that decision. So it will be interesting to see how far they can actually push this, but really the market just doesn't believe it, because, you know, that disconnect, I think, will only grow, especially if we have the Fed and the ECB kind of in that dynamic as well.
Yeah, and on that point about the BOE and whether or not they'll say, look, it's too early to start talking about rate cuts, well, that's exactly, of course, what Jay Powell was saying 2 weeks ago, and he changed tune, didn't he, quite significantly yesterday. Of course, the inflation dynamics are different here. The growth prospects are different here in the UK as well. But we're seeing gilts, again, unsurprisingly rally in the session today, up 10 basis points at the front end. You're seeing the 10-year at 372 now. Yields down 10 basis points on the UK benchmark. And you talk about the yield environment, and you talk about the BOE, and that links us to the real estate market, the property market of the UK. What is the sentiment there? Mortgage rates are coming down. Is that reading across to a little bit more optimism on a sector that has, of course, felt the pressure?
It really is. So kind of the knock-on effect from lower gilt yields is that it might actually do some of the work for the BOE in lowering borrowing costs across the economy. And you're seeing that because there's a quirk in the mortgage market here in the UK where mortgages are actually priced off the swaps market. So that's expectations of future interest rate policy, not the current base rate from the BOE. So that's why you've seen mortgage rates come down. And what the latest RICS survey indicator is telling us is that surveyors are actually the most upbeat on the prospect for sales next year than they have been in 2 years. Again, this is coming off a very kind of negative base. There's been a really, really kind of stagnant market this year. People have been refraining from putting their houses up for sale. There's also not that much buyer interest. We're seeing a little bit of a shift, at least in November. Yeah. And, you know, this was in November when we didn't have the kind of pricing in market that we have today. So December, again, I think this will be, you know, more of a turning point for the mortgage market, at least for sentiment.
Okay, yeah, that's interesting. So surveyors felt that good even before we got 5 cuts priced in by the bank for the Bank of England, and that's what we have right now. Let's turn to China, because I know there's been some interesting action there. We are perennially, or you know, always on watch for issues around debt payments, in particular to do with the real estate sector in China. What's the latest developments at Country Garden?
So sticking with the real estate theme across the world is incredibly interesting right now. Well, Country Garden, so it defaulted on its dollar bond, but it paid its yuan bond. And Country Garden is really kind of pushing hard to avoid being labeled as an onshore defaulter. For me, this signals that there's clearly a difference in perception and in priority for Chinese real estate companies when it comes to offshore creditors and onshore creditors. The priority is to make sure that they don't default onshore. They repay creditors and also sell assets to raise money onshore. But offshore, the problem is still restructuring. How long will this take? You know, the question in the long term is, does it make sense for you to be a creditor to Chinese real estate if you're not in China?
Sophia, thanks very much. Sophia Halter-Acosta from our Markets Today blog. You can get more from the blog team. Go to the Bloomberg UK website or type TLIV Go on the Bloomberg terminal.
OK, here's what else the markets are watching today then. 8:30 a.m. UK time, so in about 25 minutes, the Swiss National Bank delivers a rate decision on its policy, widely expected to hold, but the focus is going to be, the scrutiny is going to be on the language around the currency. The Swissy has rallied about 4.6% or so versus the euro, and that strength is posing a challenge. So we'll look for any language change there if it comes through from the SNB in 25 minutes' time, a little under 25 minutes. That is followed half an hour later by the Norges Bank. Markets see Norway's central bank leaving rates unchanged as well. Then, of course, 12 p.m. UK time here in London, the BOE's Monetary Policy Committee reveals its last rate decision of the year. Lizzie Burden will be on the ground for us outside the BOE. We'll be there in his shift around the Hawks. There were 3, of course, members of the MPC who voted for hikes at the last meeting. Will that dynamic shift at all? And not to be left out, the ECB, the European Central Bank, of course, watch for announcements from the ECB on its policy rate. 1:15 p.m. UK time. President Christine Lagarde holding a news conference 30 minutes later, again, as markets now pricing in, what, about 150 basis points of cuts from the European Central Bank, 157 basis points of cuts. Will she push back on that market pricing? And then there's that important data from the US, initial jobless claims, so building out the picture on the labour market in the States, coming through 1:30 p.m. UK time, Anna.
Coming up then, as the Fed fires up a risk rally on the prospect of rate cuts, the focus now shifts to the ECB and the Bank of England's final policy decisions of 2024. We will discuss the outlooks for markets next. This is Bloomberg.
the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome back. This is Markets Today, and today we have a very positive picture across these markets. All these European equity markets, including the DAX, now open, trading higher by more than 1%, up by 1.8% on the FTSE 100. Let's get to the individual stocks on the move. Joe Easton has a breakdown. Joe.
So one stock that is particularly positive, outperforming the rest of the market, is Vivendi after news that they are considering a potential breakup, saying in a statement last night that the share price doesn't correctly reflect the individual businesses they own, and we're seeing that stock soaring over in France today. Universal Music, which is a subsidiary which they spun off, is also gaining too, but there is an upgrade on that one over from Citi. Now, Citi, interestingly, saying that they think that stock is undervalued, so seem to be saying the same thing as Vivendi, so good timing on that one. Now, I've brought up Ocado. This one is really a sign of the positivity in rates feeding through into tech and also retail as well. Traders saying earlier to me that it is looking like a bit of a short squeeze across a number of stocks that are exposed to interest rates like Ocado, so we're seeing a gain there. But one stock declining is over in pharmaceuticals. This is Morphosis. It's a drug company, does a blood cancer drug. They had some really good results, sending their stock up earlier this week, but they're doing a share placing today, and that is diluting the stock, falling around 5% over in Germany at the moment. In terms of some of the breaking earnings that we've got, we did get Air France announcing better than expected margins right before the open of trading today, so that's boosting that one up 7% also over on the French exchange. Currys, now that UK outlook read pretty weak to me. They do say that UK sales fell 4% in the last half year, but maybe a bit of positivity from the broader markets and not as bad as expected. I also recently bought a massive TV, which is way too big, which I'm probably going to have to sell if anyone's in the market for one, so it really doesn't fit my flat. Bruno Cucinelli, this one snuck in an earnings report late last night. This is Cashmere Sweaters, holding up quiet luxury. Had a look at their website earlier, and they're selling a tuxedo jacket for $3,000, so I'm not sure I'll be on that website too much, but they're doing pretty well. Metro AG over in supermarkets in Germany, food price inflation coming down, weighing on some of their results, but again, it's green pretty much across the board at the moment today, so that one is gaining as well. Finally, on the last board, we've got a couple of decent ones here. We've got Marel. Now, this one is a food processing company getting an offer at €3.40 a share, a raised bid from JBT, trading at 3.14, so still not coming up to that price. ArcelorMittal, now US Steel in the US yesterday, CNBC reports that Arcelor is potentially raising their potential bid for that company, and there's also an overweight rating from JP Morgan lifting that one. Swiss Re we've brought up because we've noticed that a lot of the reinsurers are lower today. Not 100% sure on the reasoning for that, potentially due to asset values with the Fed and ECB interest rate news that we're getting at the moment, but there may well be an analyst note on that one, so we'll keep an eye there. And AMS Osram upgraded at Jefferies after a share placing a couple of weeks ago. That diluted the stock. It fell a lot, and Jefferies now sees buy rating, and that one is up 11% over in Switzerland.
Okay, Joe Easton from our equity team. You know who to message then if you're in the market for 128-inch flat screen plasma TV. Ping Joe a message. Let's get back to the macro story then, and with a particular focus as we look ahead to the ECB and the BOE, of course. But the Fed Chair Jay Powell really opened the door to some extent. Signaling rate cuts are on the cards for 2024. Of course, this comes as the Fed held rates steady for a third consecutive meeting, signaling the US central bank's aggressive hiking campaign is over.
A question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view and is clearly a topic of discussion now in the world, and also a discussion for us at our meeting today.
Okay, joining us now for the take on all of this is Konstantin Vates, Executive Vice President, Portfolio Manager at PIMCO. Konstantin, thank you for joining us this morning. As the Fed opened the door for the ECB to come forward with its own pivot, as markets price in 157 basis points of cuts from the European Central Bank in 2024.
Yeah, good morning. The market is indeed pricing a very swift disinflation back to the central bank target. I don't think the ECB will declare victory. It's reasonable to expect them that we have reached a peak on policy rates, but I don't think they will discuss market pricing too much, and will continue to focus on the data from here.
Okay, they might not want to discuss market pricing, Konstantin, but they might be asked about it. And with traders now suggesting 6 rate cuts from the ECB in 2024, does that look overdone to you, or does it look right given the weakness in some of the growth data?
I think it looks very optimistic, given there's still core inflation at 3.6%. There's uncertainty around the medium-term inflation trajectory. We have to see what wage agreements will look like in 2024, what profit margins will look like. So the market is currently very optimistic, and it might turn out that way, but I think the uncertainty is large, and I think the ECB will want to remain data-dependent, and they don't want to declare victory too early here.
Okay, so Konstantin, they're not going to declare victory too early. What about the sequencing then? You think the markets are getting ahead of themselves? What is the sequencing in terms of the cuts that come through from the European Central Bank that you are looking for next year?
So if history is any guide, then central banks might be somewhat later than what the market expects in commencing the cutting cycle, and then they might be a little bit more aggressive. So it's interesting if you look at the 2% that's currently priced as the terminal point for the cutting cycle for the ECB. I think this will be interesting to see whether the ECB gets there, because if you look at 10-year bond yield at 2%, they look attractive or less attractive depending where you think the end point is in the cutting cycle. So this will be a more interesting question to me than the precise timing of the first rate cut.
Konstantin, sticking with the ECB, there's a lot of focus on the PEP reinvestment program, of course, a pandemic-era tool that was very useful back then, and some people wonder if it's outstayed its usefulness. What would you expect them to say about that, given that it can still be useful as a sort of anti-fragmentation tool when we're focused on Italian politics, for example? What are you watching for, Konstantin, when it comes to the PEP program?
Yeah, so it is the first line of defense, indeed, when it comes to the anti-fragmentation side, and they want to be careful in removing that first line of defense because it's not obvious what would be the second line of defense. So I would expect them to follow broadly the APP playbook and announce that they think of dialing back reinvestments earlier than current guidance suggests, and they could release operational details in the first quarter of next year and then start winding down from, say, April next year. I think the APP playbook might be relevant here.
Is there a market dislocation on the back of that? Because you'd essentially be tightening policy in terms of the balance sheet whilst also looking ahead to those potential cuts coming through from the ECB. Is there a dislocation that the markets need to be thinking about, or are you relatively relaxed about that scenario?
Yes, indeed, there is a debate whether the sequencing here is relevant. I'm not so concerned about it as long as policy rates are clearly in restrictive territory, and the ECB might have just started cutting rates by then. I think it's totally consistent to wind down the PEP reinvestments into cutting. If you get into, call it, accommodative policy territory, then that might be a different story, but I think that's far out.
What's the PIMCO view, Konstantin, on the long-term trajectory for rates? I'm thinking here about post the pandemic. Do rates settle at something that looks like the pre-GFC kind of levels or post-GFC levels?
Yeah, I think the verdict is out, and a lot of observers, and I think including the ECB, currently assume that we left the disinflationary episode behind us, the low and negative rates behind us here in Europe, and we will settle more where kind of other jurisdictions settle, like the UK or the US, somewhat lower, of course, but not into negative or zero policy rates. Even Philip Lane assumes that the ECB might get towards a neutral rate of, call it, 2% over the medium term. And I think this remains to be seen, and a lot depends on the policy mix going forward here in Europe, the fiscal policies, monetary policy, and how these interact into stabilizing economies from here. And I think the verdict is out on that one.
Konstantin, we have about 20 seconds on the clock. Where do you position right now?
We are still reasonably constructive fixed income. We think fixed income is very attractive, and the good news is, particularly in Europe, you don't have to take much risk these days compared to history, so you can be in the shorter parts of the interest rates curve, and you can be in the higher quality segments of the credit spectrum and earn a decent return on your investments.
Konstantin, thanks very much. Thanks for joining us. Good to get your views. Konstantin Veit, Executive Vice President and Portfolio Manager over at PIMCO. Coming up, UBS steps up efforts to claw back bonuses paid to Credit Suisse traders. We'll have details next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. Bloomberg has learned that UBS has stepped up efforts to recoup hundreds of millions of cash bonuses paid out by Credit Suisse to former employees. We're joined now by Nick Comfort, Bloomberg's European finance reporter in Frankfurt. What signal is UBS sending them by clawing this back, Nick? Of course, these were bonuses paid to people to try and keep them through the transition.
Precisely. So it's twofold for me, really. I mean, hundreds of millions of Swiss francs is a pretty big chunk of change. And so clearly, UBS is trying to show its shareholders that it takes its fiduciary duties seriously, that it's taking care of their money and will stand in for shareholders and claw back those funds. But also, a clawback on this scale is something we haven't really, seen before. We had clawbacks are generally done on an individual basis. So for a lot of bankers at the same time, is notable. And for me, that certainly sends a signal to the rest of staff to say, hey, we're going to go through a pretty grueling overhaul. When we give you money, which is supposed to intend to encourage your loyalty, we expect loyalty. And going forward, this is the kind of actions you can expect if you don't stay in line.
Nick, switching focus, was saying with the at least with the Credit Suisse component. I remember 2017 being on the ground in China. Tidjane Chen comes along, talking up the prospects of wealth in China, starry-eyed, as so many, of course, were from Wall Street to build out their wealth proposition in China. What a turnaround!
Yes, precisely. We're seeing that the Credit Suisse China business, onshore China business in wealth, is being dialed back or even closed. And it's surprising, yeah, because also for UBS, Asia and wealth are big areas of focus. These are key driving areas. It's a business that they love. However, I think it does show, speaking to that complexity of that transaction of incorporating Credit Suisse, that they aren't willing to hold on to all the business. They are, if it's too complex, if it's too risky, then UBS does not want to carry it forward. And that's, to me, that issue of complexity is really what this story, this scoop out of Asia that we have shows.
Okay, Nicholas Comfort, thank you very much indeed on the clawback, and that is significant. Very well read story, by the way, on the terminal. And the changes there, adjustments around the Credit Suisse wealth business, letting go a number of senior staff in that country. Checking back in on your markets today, and it's a rip-roaring rally for the FTSE 100, adding 2% so far in the session at 7,699, adding 150 points. But you're seeing green on the screen across these major indexes in Europe. Very strong rallies coming through on France. The CAC Grant gaining 1.5%. Over in Germany, the DAX adding 207 points. FTSE 100, as I said, adding 2%. US S&P E-minis looking to build on the gains of yesterday, up 0.3%. The Dow got to a record. It was the best post-Fed cross-asset rally we've seen in about 15 years. Coming up, we're going to be live outside, of course, the BOE and in Frankfurt. Plenty more. Stay with us. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We're 30 minutes into your European trading day. Let's get to our top stories. Two-year treasuries continue to rally along with U.S. futures and European stocks. Fed Chair Jay Powell unleashes the bulls, signaling a pivot to rate cuts in 2024. It is Super Thursday with the ECB and the Bank of England deciding, do they push back on rate cut bets or follow the Fed? We'll be live in Frankfurt and here in the city of London. Plus, in corporate news, Vivendi soars after the French media group said it's exploring splitting up into several entities to take advantage of each unit's strength. Welcome back to the programme, everybody. 8:30 here in London then. And Tom, we have a decision from the SNB, leaving policy rates unchanged. That's as expected.
Here's what was up for debate, though, and this is the line, crucial, and this is what's moving the currency right now. Look at the Euro-Swissy cross. The SNB saying it is prepared to intervene in currency markets if needed. No surprise they keep rates on hold at 1.75%. We're in an environment of inflation of around 1.4% in Switzerland. The Swissy has rallied year-to-date about 4.6% versus the euro. Now you are seeing, let's get the Euro-Swissy cross up as well, because you are seeing, of course, on the back of this, 94.90 right now on Euro-Swissy. On the back of this line, that they are prepared to intervene because, of course, there has been focus on the strength of the Swissy year-to-date, what it means for exports out of Switzerland, the relative competitiveness. They've been selling down, or any moves, any language around selling, of course, on changing, dropping language around selling FX to, in some respects, weaken the Swissy is what was the focus. The SNB dropping that wording then on possible future rate hikes as well in the statement.
Yes, because the previous wording was something around a recurring phrase that they'd had in their statement that had implied a willingness to buy the franc. Well, the fact that they have taken that away, does that suggest a willingness to sell the franc? And certainly, if strength in your currency is what you're concerned about, then that might be the conclusion. So the SNB dropping that wording on possible future rate hikes in the statement. Sorry, so that's actually something different. That's around rate hikes. So that is not to do with the currency moves, but saying that they are dropping their wording then on, or having dropped the wording on possible future rate hikes in the statement. And as you point out, Tom, we have seen a bit of movement in the Euro-Swissy as a result. We saw some volatility, and now we're almost back to where we started pre the decision.
Inflation likely to rise again somewhat in the coming months is the line coming there. They see inflation at 1.6% in the third quarter of 2026. Let's check in on these equity markets, though, on a very strong day, of course. It is risk on. Risk on in the fixed income space, risk on in your equities markets with very pronounced gains on the FTSE 100. Hello, 7,700. Now 7,715 on the FTSE 100, adding 166 points in the session. It's not a year-to-date high, but it's gains of 2.2%. 0.5%, and that is solid, of course, for the FTSE 100. The DAX gaining 220 points, up 1.3%, closing in on that 17,000 level for the German index. The European benchmark, Stoxx 600, adding close to 8 points, up 1.7%. US futures as well, pointing to upside, Anna, after the gains, of course, of yesterday. Let's have a quick look at the sectors then and the breakdown, because the last time I checked, it was the rate-sensitive sectors that were really gaining on the back of this pivot, unofficial as it is, but the expectations, of course, from markets that there is now pivot coming through from the Fed and possibly opening up the door, of course, for the ECB and the BOE as yields drop across the curve. That is the picture across your sectors. Every main sector that we focus on in the green, the consumer part of the consumer product sector gaining 2.4%. You're also seeing strength coming through. Look at basic resources. The miners are rallying, and that's what's lifting the FTSE 100. Gains of 4%. 4% on basic resources. Financial services, industrials, all up more than 2%, Anna.
Yeah, that and pharma doing really well. And AstraZeneca, the biggest points addition to the FTSE 100. Only 2 stocks in negative territory, in fact, on the FTSE 100, as we see it outperform other European markets, which are also in very positive territory. Let's check in on the bond markets, because here we're seeing constant revisiting, reassessment, reappraisal of just how much cutting we're going to get from global central banks next year. The expectation in around the Fed, around the ECB, around the Bank of England, we've seen all of those shift in the past 24 hours. The market now expecting more cuts. As a result of that, we're seeing these yields coming down. I can see in particular in the Spanish market, the Portuguese market, we're seeing moves that are more unusual or more outsized, but we're seeing more than 10 basis points lower on 10-year products in many parts of Europe. If I click into the UK story as well, we've got across the curve, we've got moves of more than 10 basis points, some as high as 20 basis points lower in terms of those yield moves in this morning's session. So substantial movement on bond markets, reflecting renewed expectation, increasing expectation of cuts.
Wow, 21 basis point move lower on the front end here in the UK. Gilts 2 years at 4.17, the 10-year at 3.66. Traders now seeing, of course, the ECB and the BOE cutting rates faster and deeper next year. They have, of course, been boosted by those bets, of course, after a dovish pivot by the Fed. For more, let's bring in Bloomberg's Lizzie Burden outside the BOE. But first, before we go to Lizzie, it is our Europe correspondent, Maria Tadeo, who is outside the ECB in Frankfurt. Maria, what can we expect from the European Central Bank? It is their final meeting of the year. What are you going to be looking for?
And it's inside because I'm cold, so just to make it clear. But, you know, Tom, in terms of today's decision, we know that the European Central Bank very much is expected to keep rates unchanged. That means policy unchanged. And officially now, even though we know this, you know this, the entire market is positioned for this, it means that they are done hiking. And in fact, this is now a conversation that is completely changing from higher for longer, for this idea of higher rates, to now cutting rates. That is the key now. When you look at what the market has priced in for next year, 2024, more than 100 basis points in cuts expected from the European Central Bank, and that increasing now because of the language from the Fed yesterday. When you look at the timeline, some believe this first cut would happen in June, others believe it could happen in April, but there are some in the market who think it is possible to see a very early cut in March, depending, of course, on the economic picture for the European Central Bank. What matters today in this meeting, beyond this monetary policy decision, which, as I say, is widely expected now to be a hold, is whether the European Central Bank will in some ways endorse this pivot, suggesting that yes, the next will be a cut, or actually try to push back a little, because remember, this is also a central bank that is concerned, that worries about cutting too soon, because they feel the road until now has been difficult, and that could undo some of the work that they have done this year, excuse me. So is this going to be a Christine Lagarde who tries to at least delay and push back this debate until the start of next year? That, to me, will be the question. How will they position to what is now a market that has almost fully pivoted now from higher for longer to now when is the first cut?
Yeah, the role of the Fed here, really important, really interesting to watch the linkages between these central banks. Away from the monetary policy decision at the ECB, though, Maria, we're also looking for an update on lots of forecasts, also the attitude to the PEP program. But how important is all the other news flow going to be?
Yes, indeed, Anna, because I guess this is one of those meetings where you could argue the monetary policy decision itself is not the most important point. It's actually the communications around it and almost the narrative and the elements that the European Central Bank will present. And as you say, there will be new projections for both GDP and inflation. Remember, this is forward-looking, so 2024, 2025, that will matter in terms of even this potential cut pathway for the European Central Bank. Of course, if you get an economy that is quickly deteriorating and also signs that inflation is in fact slowing even faster than the European Central Bank expected, well, obviously that takes you to potentially a landing zone for that first cut. That will be key when it comes to the narrative that they want to present today. When it comes to the PEP reinvestments, let's also remember this has been a conversation in markets now for months. This idea that they will have to change and tweak the structure. As we know by now, the reinvestments would continue until the end of 2024. Some believe that has to change and be brought forward, essentially to align the monetary policy entirely. So that will be key too. Remember, the market has been expecting this decision to happen anytime now, but of course it is down to the European Central Bank to take the step. Will she now signal this clearly today? That will also matter specifically or importantly in that press conference that we're expecting from the head of the ECB.
Maria, thanks very much. Maria Tadeo for us at the ECB. Let's switch attention to the Bank of England. Lizzie Burden is at the BOE for us. Lizzie, what are markets expecting then from the BOE? And this is changing all the time.
Well, Anna, both markets and economists also expect to hold from the Bank of England at the decision at 12 o'clock. But similarly, the focus is very much on the future path for rates and the guidance that comes alongside the decision. We don't have a press conference from Andrew Bailey today. We don't get forecasts, and of course we don't have a dot plot here in the UK. So it really leaves a lot of legwork to the guidance. Previously, it said that rates would stay higher for longer. I was speaking to Michael Saunders, former Bank of England policymaker, earlier. He said that Bailey should leave the possibility of another rate hike on the table, or suggest that at least. But it really is going to be a difficult job when, as you say, you've seen markets now pricing 5 cuts from the Bank of England next year. We've also had softer than expected GDP data. So the clue to the future path for rates might come from the vote split. You could see one of those last remaining hawks turning for a hold now. But also, even though we don't get a press conference, on a day like today, maybe we'll get words from the Governor of the Bank of England, Andrew Bailey, in the form of an interview, because there is a lot of expectation in the markets for cuts next year to clear up, Anna.
Yeah, and the construction workers behind you appearing to compete for the attention of the BOE. Lizzie Burden battling through that noise barrier for us to give us the preview of the Bank of England. Thank you. And of course, Maria Tadeo on the ground inside the ECB. Sensible positioning there with that fantastic preview as well. We will, of course, be bringing you live coverage of the European Central Bank's policies decision, 1:15 p.m. UK time, and the news conference with Christine Lagarde, the ECB president. That comes half an hour later. We bring you that policy rate decision from the BOE when it happens at 12 p.m. Stay tuned. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. Happy Thursday. 44 minutes into the European trading day, and you are seeing sizable gains across European markets. 1.6% is the upside coming through for the European Stock 600. US futures in positive territory. Across your sectors, you're seeing gains coming through, of course, from the rate-sensitive sectors. Every single sector now in positive territory here in Europe. Real estate up 5.7%, followed by basic resources, travel and leisure, autos. The list goes on. Let's get back to the politics, though, of the European Union now. And leaders are meeting in Brussels for their final summit of the year. The gathering is likely to be dominated by Hungarian Prime Minister, I should say, Viktor Orbán, who opposes the bloc starting accession talks with Ukraine and a bigger €50 billion aid package for Kyiv over the next 4 years. Let's get more then from Bloomberg's John Verlaine. John, what is the opposition coming from? What is the nature of the opposition from Viktor Orbán? Why is he opposed? And what is the likelihood of other EU leaders managing to twist his arm on this?
Good morning, Tom. Well, as EU summits go, it's quite a special one. It's basically everybody against Orbán, or everybody trying to persuade Orbán. At stake is something which has huge moral significance, symbolic significance, not only for Ukraine. So basically, it's Orbán who's blocking, for the moment, both the extra aid for Ukraine and also the start of membership talks for the EU. The attempt is going to try to do a bit of budget wrangling, accommodation, compromise, because Orbán is setting this in the context of the longer-term EU budget. So it's going to be wrangling. We've already had some leaders talking about a souk, another one about a bazaar, and the attempt is going to try and reach a solution today or tomorrow, or maybe the summit could even last longer, or try and find something early next year.
Yes, John, and just where you are, in fact, very close to where you are, we see on the Bloomberg terminal the Hungarian Prime Minister Viktor Orbán is giving comments, is being asked questions by the media before this leaders' summit, and he's saying that there would need to be, his view is they'd need to manage extra Ukraine money outside the budget, and sees no reason to negotiate Ukraine membership now. I suppose this is the well-known starting position that we would expect Orbán to adopt going into this meeting.
Yeah, it's obviously the start of the negotiation. And clearly the backdrop to all this is Orbán's very close relations with Vladimir Putin, which the EU leaders can't do much about today. But there are going to be attempts, lasting obviously probably through the night, to try and find some kind of accommodation, maybe speed up the release of funds which the EU has been blocking because of rule of law concerns in Hungary. So there may be some kind of elegant trade-off, let's put it that way.
What does it mean then, John, for Ukraine? Of course, we saw the failure of Volodymyr Zelensky to convince the Senate, the Congress, the US ultimately to pass that funding bill. That still remains a negotiation in Washington. The urgency then around the funding for Ukraine and the backstop that could come through from the Europeans if indeed Orbán relents.
Absolutely. I think it's a landmark moment for gauging the West's support for Ukraine, especially when Ukraine is stalling with a counteroffensive. This money from the EU is crucial because it's going to help the Ukraine state, keep going. It's for its domestic spending, but of course there's also all the military spending involved. So it's a very symbolic moment to show whether the West can remain united, and bear in mind that in the EU and the EU leaders, they have to reach a unanimous decision on the Ukraine aid package.
Yes, and in the run-up to this summit, we've seen the EU decide to give some of the money to Hungary that was due to Hungary, but then had been blocked because of the stance that Viktor Orban is taking with regards, well, no, but not because of that, because of other matters, other areas of fallout between the EU and Hungary. But now this exacerbated by the stance that Hungary is taking on this particular matter, the EU deciding to release 10 billion euros of aid. What is the significance of that, do you think, John?
That's right. Well, that was expected because the EU judged that Hungary has fulfilled the conditions that were linked to this, but we've got another packet of money, about 20 billion, which is what Orban is insisting on, and that could form the possible link with greenlighting the aid for Ukraine.
John, thanks very much. Thanks for joining us. Good to get the update. So Bloomberg's John Verlaine with the preview of what to expect from that EU Leaders Summit and those comments coming through from the Hungarian Prime Minister Viktor Orban just as they get ready for that summit to take place. Coming up on the programme, the aviation sector in focus. Air France KLM shares are moving higher as the airline group signals higher profitability over the next 5 years. The details next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today, 8:52 here in London. So 52 minutes into a really stellar session for European equity markets. The CAC and the DAX hitting record highs. The FTSE 100 up by more than 2%, off earlier highs perhaps. It was up a little more than that, but still incredible performance across these European equity markets post the Fed. And we see only 2 stocks actually in negative territory on the FTSE 100. So certainly a very strong day for stocks underway. And in terms of the sector picture, only the insurance sector has been under pressure a little bit earlier on today. Elsewhere, we are seeing positivity. That remains the only sector in negative territory. Let's move on to the aviation space. Air France KLM shares soaring today after raising its profitability outlook over the next 5 years. Let's get more from Bloomberg's Benny Camel, who covers the global aviation sector. Benny, run us through some of the numbers then and market reaction, because I thought that we'd been through a real boom time for aviation, and to some degree, I think expectation was looking a little shakier for next year, but perhaps not so.
Well, it's hard to say whether this is the last hurrah for 23 and the next year things are going to look tougher. But for Air France, certainly today, a very good day. The stock up almost 8%. That's the best in 3 months. And investors are really buying into that slightly higher operating margin outlook. They say they can exceed 8% now. Previously, they had a band of 7 to 8%. So just up a smidge, but it sort of gives you a sense that everyone is clamoring as investors for higher returns. This is an industry that isn't really vastly profitable, so anything you can get, you get the good news. And if you compare that, for instance, to IAG, the owner of British Airways, they had an update a couple of weeks ago that was a little bit thin on details, and investors didn't like that, and the stock fell. So the more you can give investors, the more they like it. There'll be an update from the CEO, Ben Smith, this afternoon. They have an investor day, so we'll probably hear more then.
Benny, what is the broader outlook then for the aviation industry as we look into 2024?
Well, 24 still looks robust. I mean, this has been the year of revenge spending. We had some of that last year, and it sort of lingered in this year. Next year, if you take the numbers and the forecast from IATA, the industry group, they came out last week saying, yes, things will continue to improve, but sort of not as explosively as they did this year. This year, we went from a very low base. They came into the year thinking they would have about $4 billion in profit as an industry group, and they ended the year with more than $20 billion. So really, things have gone up dramatically for them this year for the industry. Next year, it'll probably remain largely where it was this year, and what people will be looking at is sort of the blend of the cabin. Are people still paying these premium cabin seats? Is corporate coming back? That's one of the big unknowns in the industry. So lots to look forward to in terms of sort of the movement within the cabin. What are people booking? Are they still splurging? There are signs that that's coming off a little bit.
Okay, Benny Camel on the aviation sector and looking out to 2024, joining us out of Berlin with the latest there as we look at travel and leisure, one of the sectors, of course, gaining in the session today as we see risk on across these markets, that sector adding 2.3%. And let's remind you what is underpinning this, because it's the market re-rating, of course, around these central banks. And we'll just look back briefly at the Fed before we look ahead to the ECB and the BOE. And, of course, the 75 basis points that has been flagged by the dot plots, the forecast coming through from the Fed yesterday. Goldman Sachs, Jan Hatzius, interestingly, revising and pulling forward their expectations for cuts from the Federal Reserve. Earlier and faster cuts is what is expected from Jan Hatzius, who was looking into the producer price inflation of yesterday. He sees 3 cuts, 25 basis points kicking in March, May and June, Anna.
Yes, and the market now increasingly desperate for a global pivot on interest rates. Then we've seen this from the Fed, and this is clearly set in train a rethinking of expectations around rate cuts, both in the US and in many other geographies. We've seen it on the ECB and the Bank of England. And with the ECB, the inflation rate has been coming down pretty fast, so much so that we got those comments from Isabel Schnabel just a week or so ago, somebody who was previously pretty hawkish, sounding pretty dovish. So it seems as if the ECB wants to step through that door, the Fed has opened it just a little ajar for them.
And does the gravitational pull apply as well to the Bank of England in light of the stickiness of the inflation print here? 4.6%, but we're seeing gilts moving aggressively again, yields down, 17 basis points on the 2-year, 14 basis points on the 10-year at 369 right now.
Yeah, we'll look at the number of dissenters at the Bank of England, perhaps, because 3 dissenters is what we had last time around. Will we get that same number this time? That is it for markets today. You can get insights from us and the team that puts together the programme. Bloomberg UK website will take you to the blog, or TLIV Go on the terminal. This is Bloomberg. adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges.
What's next?
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is it be okay? Is getting ready to make a decision.
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fed Chair Jay Powell unleashes the bulls, signaling a pivot to reversing the steepest rate hikes in a generation. Traders now price 150 basis points of cuts next year. European stocks rally. UK stocks look set for the biggest surge of the year. The DAX and the CAC hit record highs. And it's decision day for the ECB and the BOE. Do they push back on rate cut bets or follow the Fed? Plus, Hungary could oppose a European aid package to Ukraine as EU leaders meet in Brussels for the final time this year. So it's very clear we're looking at a monetary policy pivot for the first time. Wall Street, but also Fed officials seem to be aligned that cuts are on the table. That's repricing and changing everything. Certainly in Europe, you can see a nice little boost. We see record highs for a lot of these indices. But the FTSE is almost getting some 2%. The CAC 40, 1.2% higher. And again, this is on the back of already a pretty strong rally. This is what we're looking at in terms of live pricing. So the CAC and the DAX at a record high. We'll have a good look at what this also means for euros. So I think we have that. There you go. It's just always good to look at what this means in terms of record. Fourth at 479 for European stocks. You can see the DAX at a record high, and so is the CAC 40, 7,619 points. Now, in terms of central bank, a little bit later, we have the Bank of England. We also have, of course, the ECB. We're also getting the Norges Bank rate decision breaking as we speak. And they basically are suggesting that the rate may be lowered earlier than they had thought. But for the moment, that interest rates is pretty much, it's been raised to 4.5% instead of the 4.25 that it was estimated. So it's interesting the way Norges Bank is trying to position itself, saying that the rate may be lowered earlier than currently seen, but at the same time, for the moment, they're actually raising it up. So medium short-term risk to, I guess, inflation, but then it's clearly that they also see the trend downwards for next year. So lots of central bank action. That's probably the understatement of the decade. Lots of action today to dissect it all. We're joined by Catherine Nice, Chief European Economist at PGIM Fixed Income, and Jamie Rush, Chief Europe Economist from Bloomberg Economics. I mean, it's a bit of a whirlwind because we have so much to grapple with. And Catherine, we have it. I mean, finally, like Wall Street called it right. They're expecting, cuts next year from the Fed, and Jay Powell, said so.
Absolutely. I think the big question is going to be whether other central banks follow suit. I mean, you've just talked about what's happened in Norway. Really, we're not expecting rate hikes coming from either the Bank of England or the ECB, and it's all going to be about the tone. Are they going to have a similar kind of tone that we heard coming from the Fed in terms of what is the outlook for rates? What's the prospect for early and aggressive rate cuts? I think that's a bit more of a question mark, but clearly the Fed is signaling that 2024 is going to be a year where rates are more likely to be lower than not.
Catherine, I think the only question we have, and I want to put that to Jamie, and I know we have also Maria today on the ground at the ECB press conference for later, are they doing it for the right reasons, i.e. inflation coming down and they want to give themselves a little bit of room, or are they actually going to cut rates for the wrong reason, which is looming recession, if we're not already in a recession when the Fed starts cutting?
So I think for the U.S., it is very much a case of adjusting peak rate and that the prospect is still there for a soft landing. You can see it, for example, in the jobs data. It looked reasonable, but if you kind of strip out what you might think are structural drivers of employment, there is clearly cyclical weakness. But I think the prospect of a soft landing in the U.S. is still possible. The story in Europe is really very, very different. I think the only scenario where we could see really early and aggressive rate cuts coming out of the ECB is if we think that the euro area economy is really going to start to deteriorate from here. That would not be my base case. I think we're seeing signs of bottoming out, but that will depend on what data flow we get over the coming weeks and months.
Jamie, your team has done an outstanding job really in getting right what the BOE will do when many have gotten wrong in the past. I mean, we had now aggressive pricing in the markets of how many cuts the Bank of England will do. Is that correct, or is the market just getting ahead of themselves?
Well, I mean, I think it's important to recognise the Bank of England has a slightly different scale of problem relative to what the Fed and the ECB are seeing. I mean, the ECB
bigger
doesn't.
problems?
Yeah, because we have very strong wage growth here in the UK that isn't showing signs of really ameliorating too fast. Eurozone obviously is very different. They don't really have a wages problem. They're free to do what they like. So I think the bank they're unlikely to be able to cut on the same sort of timetable as the Fed. I mean, inflation is going to be 4% well into next year. I think it's much more likely they'll have to go a little bit later. But are markets right to expect that perhaps they'll do it a bit sooner than they previously thought? I think that's a reasonable expectation. I mean, what we're seeing, and one of the things that struck me from the Fed was this emphasis on forecasting back on if you wait till you get to 2%, it's too late. I mean, that applies for all central banks. So if there's more emphasis on the forecast, then that'll free the Bank of England up to do a little bit earlier.
But, and again, Jamie, this would be the BOE cutting into a recession for the UK, or are they just cutting in line with inflation?
No, I mean, I think that the outlook for the UK is pretty poor. We do have a recession in our forecast. It's relatively mild, but it's a recession nonetheless. So the Bank of England will certainly have the capacity to cut on that basis if they want to.
Catherine, how much do you worry about the Bank of England and the prospects for the UK?
I mean, I'm really quite aligned. I think that the outlook is pretty much more of the same into 2024, what we've seen for this year, the economy moving sideways, barely registering positive growth, inflation continuing to come down. But, as we've said, the UK does have a bigger inflation problem. They probably paused a little bit earlier relative to that inflation problem, earlier this year, which means that they're going to need to be, higher for longer relative to other central banks. But of course, in the scenario where things really deteriorate from here, I think the Bank of England would be on it. I think they'd be early. I think they would be aggressive. But I'm not convinced that we're in that space yet for the UK.
Let's head over also to Frankfurt, the ECB up next with Christine Lagarde and colleagues, of course, facing this deteriorating economic outlook for the euro area with this backdrop of rapidly slowing inflation. So let's get straight to Maria today. Maria, I guess I don't know whether Madame Lagarde will push back against this idea of rate cuts. If she does push back, she'll have to forcefully push back after what we heard from the Fed. But also they have they have to phase out PEP, and so it'll be interesting how she deals with that.
Absolutely, and you see it's complicated for the European Central Bank today. Forget about the monetary policy decision itself. We know they are going to hold on the entire morning. By the way, we've talked about the cuts going into 2024, so already that tells you a lot about the zeitgeist. Francine, this is a central bank that is obviously going to have to respond to a pivot that has been made by markets already. We've long moved from this idea of higher for longer, higher rates to now fully going into cutting rates. And as you know, there's some that believe you could even see a rate cut in March next year, depending on how the economy deteriorates. So obviously the forecast too, which will be presented today, will matter in terms of the narrative that they want to paint, but also just how credibly they want to push back to this idea of earlier cuts, if that is indeed what the European Central Bank wants to do today. Remember, we will get projections for inflation for 2024, 2025. That is crucial in terms of signaling that this is a central bank that is now convinced they will get to the 2% target. Remember, there are fears in the Governing Council that cutting too soon, being pushed by markets into cutting, could be dangerous too if that means they do it too fast and undo the work that they've done today. When it comes to the PEP, Francine, I think you nailed it too, because there is a sequence now, and it's almost understood that the PEP will have to be changed, brought forward, accelerate the ending before you're able to cut. Is this a day where finally the ECB gives the signal that this will happen now? Remember, the markets have been positioned for it for months, but of course it is a complicated one, because today it's all about, forget about the monetary policy decision, just look at the communications. And the Fed yesterday, of course, has increased this pivot. Can they push back? Will they want to push back? Or actually, do we get an ECB that says, yes, cuts are next, but we just cannot give you a timeline for the time being?
Maria, thanks so much. Maria Tadeo, our Bloomberg Europe correspondent. Maria, I have this thought in my head every time if you're another central banker and you're watching the Fed and you're watching, of course, Jay Powell, and you're thinking, you know, you're either positive, it's like watching the football, you're either positive and saying he just made my job a lot easier, or he's just made my job tomorrow so much harder. We'll, of course, be bringing you live coverage of the ECB's policy decision, 1:15 p.m. UK time, that news conference with the ECB President, Christine Lagarde, half an hour later. Jamie, I guess when you look, I mean, it seems that everything depends on new projections from the ECB simply because we had this steep decline in inflation, but we don't know how much more that continues. So, you know, what's your sequencing of what the ECB does in the next 6 to 8 months?
So I think, I mean, just first on the PEP program, I think now is the perfect moment to make decisions about that. We've got global sell-off or global decline in bond yields. That is the right moment to do it. So I think they'll consider it, and they may make an announcement today, or they may just hammer out some details early next year. On rates, I mean, we're expecting inflation to fall pretty steeply, both on the core measure and the headline measure for the Eurozone through 1Q. That could open the door to a March cut. That is a possibility. So I think we'll be looking for Lagarde for some pretty big pushback from Lagarde today on market pricing for rates. If we don't get it, I think that would be a sign that things are starting to creep forward.
And you agree with that, Catherine? There's going to be a lot of pushback.
I would expect her to have a hawkish tone. Whether it works, I think that is the open question. And I think, ironically, by saying something on the PEP, which I also agree, I think it is quite likely. They've told us in the last two meetings that they hadn't discussed it. Then the President Lagarde went to the European Parliament, said they're going to discuss it soon. So I think it would be unusual for them to come again at this meeting and say we haven't discussed it. So my expectation is that they will have. And on the face of it, it feels like, well, that's quite a hawkish signal, bringing forward the end of PEP reinvestment. This is very much a governing council that's still in normalization mode. But I think, ironically, the market is going to take it as a dovish signal, because by announcing something on PEP now, it effectively gives them the nimbleness, the ability to bring forward cuts early next year if they deem that to be necessary for the euro area economy. Again, it's not my base case, but I think the market will see it as the central bank paving the way, opening up the possibility for them to be able to adjust rates as needed.
But Catherine, given where we are, and again, I mean, I was joking around and, you know, imagining Lagarde going, the Powell is making my job so much harder. But is there anything that the market would interpret as hawkish today, given the general mood out there from the ECB president? They've ignored central bankers in the past.
Yes, I mean, I guess the big surprise would be, you know, anything that really indicates that they are seriously considering raising rates further. Because I think for the market, raising rates now is, you know, pretty much entirely off the table. We are at peak rate, and so it's all about the downside. It's all about the timing of the cuts, the extent of the cuts. So anything that would, you know, lead the market to think, hang on a minute, maybe we don't, you know, We haven't seen, for example, the breakdown of the HICP, the inflation numbers for the euro area. Presumably, they've got pre-release access to this. Perhaps there's some bit of data that they have seen that we haven't seen that would indicate there's a lot more inflationary pressure. But it's hard to imagine what that would be at this moment.
Very quickly, because we need to take a break and then we'll come back more. Norwegian krone is climbing. I mean, this was a surprise hike. Should we take more notice?
I think it's pretty idiosyncratic, and the fact that it's coupled with guidance that they think they may have to cut sooner. I mean, I think that tells you pretty much what you need to know.
Okay, thank you both. Catherine Nice, Chief European Economist at PGIM Fixed Income, and Jamie Rush, Chief European Economist for Bloomberg Economics. Both stay with us. We'll have plenty more on global central banks and the battle to tame inflation. That's next, and this is Bloomberg.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So you're looking at Vladimir Putin there with his annual news conference and call-in show. Now, this is something that we've been accustomed to in the past. It usually lasts 4, sometimes 5 hours. Of course, this is in a different context because his armed forces still on the attack in Ukraine. The re-election campaign is getting way in Russia, and he just started about an hour ago. This is a marathon news conference, basically, with call-in from his constituents. So we'll keep an eye out to see whether there is any news. He's talking about the economy right now, saying 2023 inflation in Russia seen at 7.5% to 8%. Now, we usually cover it from the perspective, from the lens of oil and the fact that actually they haven't done as badly as we thought, despite all of what the West has tried to do in terms of sanctions. So let's go to Jamie Rush, our European economist at Bloomberg Economics. Also, Catherine Nice, Chief European Economist at PGIM Fixed Income, is with us. I mean, if you look at Russia, I mean, it's incredible, actually, to see in the last couple of weeks, you know, the Russian president also going to the UAE. I mean, he's trying to take a more international role, still with this, you know, horrible Ukraine war going on. But can you brief us on the economics of the country?
Well, I think so. If you think about what happened to Russia's economy following the invasion, I mean, people were forecasting there'd be a drop in GDP of 10 to 15%. That hasn't happened. We were also expecting that sanctions would limit the Russia's capacity to wage war in Ukraine. That's not happening either. When you look at reserves, they're piling those up in China. There's nothing that's happening on the economic front which is limiting their ability to wage war. But what we have seen from the US is that they think that the Russian economy is perhaps 5% smaller than it otherwise would have been as a result of the war. Why is that?
Which is not huge.
It's not huge. It's not enough to prevent them from doing it. But we are seeing the longer-term consequences of the invasion on the Russian economy, partly because they've had to mobilize so many resources to wage the war. And that we've seen a huge shift out of sort of construction, retail, into fighting the war, and that has, of course, operated as a big drag on the private sector outlook for Russia.
Yeah, this is so interesting. We'll continue, of course, keep an eye on what Vladimir Putin is saying. Talking about inflation, I haven't heard him talk about inflation in quite some time. Catherine, the other big story is, of course, the German economy, because of the budget deficit and the fact that it took everyone by surprise, the fact that the Constitutional Court slammed against it, and then they found a way to work through. Like, where's Germany on your radar?
So I guess the good news is that when we talked about this a few weeks ago, I think the view was perhaps the hit to Germany's fiscal isn't going to be as big as the headline 60 billion euros. So I think that does seem to be the case. It is a smaller order of magnitude, maybe more closer to 15 billion. Nevertheless, against a backdrop of a region that is, really stagnating, every little bit helps, and this is definitely not going in the right direction. Germany is Euro area's largest economy. There is a lot of evidence that, papers, academic work coming from the ECB and elsewhere that suggests that what Germany does on fiscal obviously is going to impact Germany, but it's going to have spillover effects to the rest of the Euro area. So I think there is a concern. It's not coming at a great time. Near term, it does going to mean other things equal. The economies will be weaker, not just in Germany, but elsewhere. And I think the other spillover effect is how this is impacting on the EU's negotiations around what's the new Stability and Growth Pact going to look like, which could mean that you've got, more austerity to come, perhaps not in 2024, 2025, but in 2026, 2027. So again, that in turn could hamper things like public investment, again, acting as a drag on growth in a region that's stagnating. It's not great news.
So I know we're jumping around, but we just have so much news and countries to get to. The Swiss National Bank, the SNB, I'm looking at the franc, it's pretty choppy, actually. The SNB held rates, but it seems to have been a pretty dovish statement.
Yeah, we look at Switzerland, we don't really have an inflation problem in Switzerland. It never took off in the same way as it did elsewhere. Why? it helps to have a lot of hydropower. That kept electricity costs at bay. But they're not facing the same sort of outlook. So it's pretty clear that they can just sit back.
All right, thank you both. That was a great panel. I could have you on for like 3 hours just talk about central banks. Catherine Nice, Chief European Economist at PGIM Fixed Income. Jamie Rush, Chief Europe Economist from Bloomberg Economics. And then at 9:30 a.m. Bloomberg UK will be speaking with the former Bank of England MPC member Martin Wheel. We'll bring you, of course, to that BOE policy decision when it happens, and that's at 12 p.m. Coming up, Hungary could oppose a European aid package to Ukraine as EU leaders meet in Brussels for the final time this year. So that's coming up next. And this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Hungarian Prime Minister Viktor Orban looks likely to dictate the outcome of an EU leader summit later today. Now, Orban has been pushing to block funding for Ukraine and obstruct the start of talks for the country to join the EU. Now, for more, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, as always, thank you. So why is Hungary actually rejecting the EU's Ukraine aid plan?
Well, what they're doing is they're trying to tie the funds for Ukraine, unlocking those funds for Ukraine to money they say they're actually owed themselves from the EU. They're also objecting to the idea of committing to a 4-year plan for Ukraine. They're saying that's far too long to commit to financial aid because who knows what the world's going to look like in a year from now. They cite things like the possibility of changes in administration in Brussels itself, the US election cycle feeding into that, and they say it's simply too much and they don't want to do it. However, they are indicating they will negotiate a little bit on the money. They might be open to something in the short term, and that's really important for Ukraine. Of course, we know that also the funding arrangements from the US are very much tied up in the US Congress at the moment. There's been no movement to unlock that aid also, and Ukraine is saying quite simply they need this money urgently or they're going to run out of cash. They're also going to run out of stuff to fund their war machine and the ability to continue to push back against Russia on the ground. So it's quite a high-stakes summit in Brussels that's starting today. The key really is, can they negotiate some sort of solution for this with Hungary, and for how long?
So also underway at the moment, Roz, Putin's annual address, a very lengthy annual address. What have we learned so far?
Well, it is a 3 to 4 hour affair. He takes questions from the press and then he takes carefully screened calls from the members of the public. What we're hearing so far, very much talking up the resilience of the economy. This is aimed very much at a domestic audience before, of course, he seeks re-election where he's expected to succeed. But what he's saying is the economy is held up very well despite the war. It's showing resilience. He's also saying his goals on the ground in Ukraine have not changed. Very much a message that things are going as business per usual for him. Of course, it's a very different scenario potentially, but that's his message so far.
Roz, thanks so much. Roz Matheson there with the very latest. Of course, on Russia, coming up, the former BOE MPC member Martin Wheel joins us on Bloomberg UK.
York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and markets. I'm Francine Lacqua here in London. Now, it's a big week for central banks, not least of which the Bank of England. Traders now piling into bets on BOE rate cuts next year, pricing in 5 cuts of 25 basis points next year. Now, it follows signaling of possible U.S. rate cuts next year by the Federal Reserve. That's despite UK inflation remaining sticky compared to the EU and the US, and some UK economists saying that the BOE may use this week's rate decision to warn that borrowing costs must remain elevated well into 2024. Now, the former BOE Monetary Policy Committee member Michael Saunders has told Bloomberg that the bank could keep the possibility of further interest rate hikes in their language, and warns that the UK is really stuck in a slow growth rut.
Lower potential growth has weighed on the UK economy significantly over the last few years. Look, real GDP per head on the IMS figures for this year will still be below the 2019 level, and the UK over that period has been the worst performer among the G7 countries. And it's not likely to get any better in the coming years. I have to say, low potential growth doesn't really make the UK more inflation prone, because it also bears down on the pace of demand. So low potential growth is neutral in terms of the output gap, which is what matters for the inflation prospect. But it means that the UK is just sort of stuck in a low growth rut. As for the fiscal arithmetic, look, there are quite a lot of moving parts. Lower bond yields since the autumn statement will help the fiscal arithmetic. If the OBR project lower migration, that would harm it. And there may be other moving parts between now and the budget. I think it's too early at this stage to have an assessment of whether the fiscal position will look better or worse. But the fiscal space, in any case, is very limited. And the government's fiscal plans at the moment rest on large, unspecified, and frankly implausible cuts in real public spending over the next few years.
So we'll have, of course, plenty more on what the BOE will or won't do. A lot will depend, of course, on market bets and whether the governor thinks that he needs to really push back against this. Now, this is the picture overall for markets. If you look at some of the record highs we've seen on the CAC 40 and, of course, elsewhere in the DAX. That hasn't quite filtered through to the UK, but it's very clear that stocks and bonds are rallying as traders are betting on rate cuts from the Fed. You can see sterling 126.57, the 10-year yield 3.676. This is a picture across the board. Now, let's also look at what other things are doing. Now, the traders are, of course, betting on rate cuts, and that's changing everything. If you look on the risk on a rush following some of the dovish signs yesterday from the Fed, which held rates steady and forecast that their next move could be lower. I'm looking at the dot plot. We don't always look at the dot plot. We should probably look at the dot plot a little bit more, showing that 75 basis points of reductions in 2024, a sharper pace of easing than indicated in September. So let's discuss the UK outlook with economist Martin Wheel, who's also a former member, of course, of the BOE's Monetary Policy Committee. So thank you so much for joining us. Martin, give me a sense, first of all, on whether Andrew Bailey's job and the MPC's job has been complicated by what we heard from the Fed yesterday.
Well, the Fed does exert quite a gravitational force on interest rates throughout the world. My guess is that the Bank of England will want to be rather cautious about suggestions that rates might be cut substantially next year. We have wage growth at 7.3%. We have core inflation of 5.7%. We have services inflation of 6.6%. And of course, what we actually need is inflation of 2%. So there is still a long way to go. But if the Fed is cutting rates, then, as I say, that does exert a gravitational pull that perhaps the Bank of England would rather be without.
Okay, so traders are now betting on 5 BOE 25 basis point rate cuts in 2024. I mean, is that excessive?
Well, I don't know what's going to happen, what the future's going to bring, but it seems to me making quite strong assumptions about how the remaining inflation is going to be squeezed out of the system.
Martin, give me a sense of how do you think a hawkish hold will actually be communicated? I know if you look at BOE members, they have been split in the past. We're probably expecting them to remain split right now. But what does the messaging need to be in terms of also, you know, financial conditions being tightening that would help the BOE going forward?
Well, I think what the Bank of England needs to say is that it wants to see inflation fall sustainably to 2%, not simply benefit from the effects of unwinding the sharp increases in fuel and energy prices that we saw last year. And, of course, those two are very different things. As Charles Goodhart was saying in the Financial Times this morning, there are reasons for thinking that maybe inflation will start to pick up again towards the end of next year. And that, of course, will be all the more likely with financial conditions easing as they are now.
Do you think the Bank of England is done hiking?
Well, it's very hard to say. I think probably they are at the top, but it does remain to be seen how far and how fast these indicators of underlying inflation do come down, and we don't actually know that. I mean, what we can say is that wage growth in Britain is perhaps higher than in the United States, and that it's obviously a good thing for people who are getting wage increases, but it does create more of an inflationary problem.
And you're absolutely right. We don't know, but you're a great student of the UK economy. You've had to vote, of course, on MPC decisions in the past. How tricky is it right now for Governor Bailey to get it right?
Well, it's always tricky to get it right. I think the problem he has is that if headline inflation falls to close to 2%, which it may do, there will be a lot of political pressure on him to encourage the MPC to cut rates. Remember, it's the MPC's decision, not Andrew Bailey's decision alone. So there will be a lot of pressure on him, and he will have to be, or the committee will have to be very aware of the indicators of underlying inflation, looking at what's happening in the labour market and not simply being influenced by the headline figure.
Yes, and you know, we have a great, actually, Bloomberg story looking at the BOE's most hawkish member, Catherine Mann, an external member who also described herself possibly as being on the hawkish side of things. And then we have a great profile also on Jonathan Haskell, external member as well, saying that there's probably no prospect of early interest rate cuts. So it probably gives you the two, you know, barometers, the two sides of things. But Martin, if you were to vote, what kind of rate path do you see over the next 6 to 8 months? Are you more worried about the low level of productivity, or do you want to make sure that actually we don't see a recession?
Well, what I'm worried about is making sure that inflation is sustainably squeezed out of the economy. That's the primary job of the MPC, and I always saw that as the main influence on my voting decision. You know, things were simpler while I was a member than they are now. Subject to that, of course, the MPC has the obligation to support the government's aims for the economy, which I've always aims for growth and employment, which I've always taken to mean support employment and support growth. But that is only subject to delivering on the inflation target. So I would be very much bearing in mind the primacy of the inflation target.
Dave Ramsden, the Deputy Governor for Markets and Banking, says he's worried that inflation is more homegrown. Would you agree with that?
Well, I think if you look at what's been happening to wage growth and you look at what's been happening to services inflation, then you can say that there is a lot of homegrown inflation now.
And so what does that mean in terms of decision making? If you, again, we've had these GDP figures, Martin, that weren't great for the UK. So are we now faced with a stagnant economy, and it does whatever the BOE do, can it actually tip it one way or the other?
Well, the Bank of England or the MPC does have an influence on the growth rate of the economy, but could I repeat that their primary function is to deliver 2% inflation, and they've always argued that delivering low inflation was the biggest contribution the committee could make to sustained economic growth, and I think that's still true.
But given all of the, I guess, nuances, do you think a 5.25 key rate interest rate, you know, makes sure that inflation continues to fall downwards?
I think it probably does. I think, no, we are now in a situation where there are downward pressures not only on headline inflation, but also on services inflation and wage inflation. So I think sustaining the rate where it is now probably will bring those back towards target. Of course, back to a point consistent with the target. Of course, once you get there, then there's the question, or rather on the path there, there's the question, how rapidly do you need to cut rates so as to minimize the impact on output? And that's always a difficult question.
Martin, how are you expecting actually the labor market that has so far been tight and so has held up quite strong? How do you expect that to behave in 2024?
Well, I think if rates don't fall as rapidly as indicated, if financial conditions don't loosen as much as markets seem to be imposing at the moment, then I expect that the labour market will continue to ease. Of course, we do have these problems with the data, but if we look at what's happening to wage growth, that has turned down now, and that is good news.
Great. Thank you so much for joining us. Martin Wielder, former member of the BOE's Monetary Policy Committee. We'll have, of course, plenty more on the outlook for the UK shortly. This is Bloomberg.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg UK. Now let's discuss the prospects of stagnation and low growth with Bloomberg Economics' Anna Andrade and John Stepek, author of Bloomberg's newsletter, Money Distilled. It's very good, so I hope you're all subscribed. Anna, talk us through, good morning, first of all. How rude of me. Good morning. It's a big central bank day. Like, our head is spinning, and I think a lot of the central bank governors are probably just, you know, re-looking at what Powell said. And if you look at the growth prospects for this country and inflation, I mean, is it so much harder to put monetary policy for the UK just because everything seems exacerbated? It's a small, open economy.
Yeah, good morning. So yeah, it's definitely a challenge that central banks face because essentially if your supply is limited, you can only grow at a very, very slow pace without generating inflation. So that's something that needs to be solved. Monetary policy doesn't really have the tools. I mean, central banks don't have the tools to solve it. So it really needs to be up to the government to kind of, you know, channel the right resources, make sure that investment increases and make sure that productivity gains pick up again, because we had a major fall in productivity growth. If you compare like the 3 years going into the global financial crisis, labor productivity was averaging above 2%. Now it's just been stuck at 0.4%. So kind of, you know, something needs to be done on that front.
Yeah, I know John's going to push back against me because every time I say something mildly, you know, not negative, but even Andrew Bailey, John, said, you know, the UK is facing its worst outlook in his career. Inflation more than double the inflation target, worker pay rising rapidly. You're pushing back, aren't you?
Well, yeah, I mean, Andrew, this time, kind of like last year, was saying we were going to be in a kind of generational recession by now, which we're not. I mean, I think one thing you have to say is that the outlook going into 2024 is actually a lot more positive than it was this time last year.
Which seems crazy, John, given where interest rates, I mean, interest rates have gone up by so much. It's incredible that we haven't had a big event or a big credit event or elsewhere, right?
Absolutely. And I think the one thing that most people have underestimated is how resilient the financial system is post-2008. I mean, it sounds mad, but actually the things that were put in place after 2008, they had a lot of bad side effects as well. They probably restricted, you know, the kind of growth to an extent. But it also had the, you know, the benefits of making the housing market, for example, in this country much more resilient. You know, lending standards were better. So as a result, the kind of national balance sheets of any country that actually suffered a big crash in 2008 are actually much more resilient than they were back then. Whereas places like Canada and Australia, which didn't have the same sort of pain in 2008, are now, you know, consumers are much more indebted than they were. Companies are generally a bit more indebted than they were. So actually, you know, we came out of 2008 in a bad shape, but we went into this in a much better shape than I think most people understood at the time.
But, and I mean, again, to you both, but I mean, the idea that actually instead of having like an ugly recession, but a quite quick recession, the idea that now we could look at a protracted slump, Does it make it harder to balance interest rates to get it right?
Yeah, I mean, I would agree with John that we've had, it has been a story of resilience. If you do put, the interest rate path that we've just had in such a short amount of period into any model, it would kind of suggest that, we would be expected to have a 5% hit to GDP, and we just haven't had that. Now, I guess the question going forward is whether we need a downturn to bring inflation under control or not. And I mean, our view is that we do need a mild downturn in order to bring inflation under control, but it might be that we don't, and the implication of that would be that supply is stronger than we expected. So actually, just by holding in this kind of stagnation, status, the economy in itself can, push down on price pressures, but I guess that's the question going forward into 2024.
So, Anna, when are you expecting cuts from the Bank of England? And again, the markets are frankly behaving like it's a bit of a party, right? The Fed's going to cut, the BOE is going to follow, and everything's good. But if they're cutting because we're seeing a recession, then it complicates matters.
Yeah, I mean, I think that's one of the reasons why we've been saying that the BOE will cut even before inflation hits 2%. It essentially kind of will feel comfortable cutting when inflation is kind of at 3%, which is not ideal because the hardest part was always going to bring inflation from 3% to 2%. But it will be open to do so if it sees the economy, weakening. If you look at the timing of the meetings that we're going to have and at the inflation, I mean, inflation will still be running at around 5% until January. That for me feels like too early to cut, so February is a no-go. And then, March and April and May, I also don't see them cutting just because in our forecast, inflation gets to 3% in the April CPI, but we'll only have that after the May meeting. So the earliest we see is actually June. That will leave the BOE a little bit later than the Fed. Yeah. But I think that's reasonable just because the inflationary episode was so much worse here in the UK. So it's likely that the BOE will kind of be the last one to move.
John, what's your take?
Well, I think it's really interesting because if the market's already pricing in these rate cuts...
And many of them.
I mean, you remember the main transmission mechanism to the consumer in the UK is the mortgage market. The thing is, because there were so many fixed-rate mortgages, the full hit from the 5.25% hasn't hit, but now we're cutting, and a lot of people are remortgaging in 2024. They're going to be remortgaging it closer to 4.5%, maybe sub 4%. Than maybe the 5 or close to 6% they were expecting. So in a funny kind of way, you're short-circuiting the transmission mechanism before it's even hit. So I actually think there's a serious risk that it's a good risk, but there's a risk that the UK will have actually quite a much stronger economy next year, particularly the latter half of next year, because consumers aren't going to be as under the cosh as they've been this year. So it's going to be a hard balancing act. But I think your point, Anna, this is not really something the central bank can fix. It's something that government needs to kind of improve the kind of, the efficiency of the economy. And of course, we've got an election coming next year, so that's not going to happen.
But John, I mean, it'd actually be genius, right? If they're cushioning mortgages, they're basically setting monetary policy for mortgages, which in the UK is such a huge factor in the economy, then actually they could be really getting it right.
But I mean, they could be getting it right, except that if everything, if we're off to the races again, then the risk, of course, is that inflation takes off again. But that is, that can go either way, because if people feel that energy bills aren't going up and that their mortgage bill isn't going to go up, that takes pressure off wages, because people aren't going to be demanding higher wages. So, yeah, maybe we'll get a really nice soft landing and everyone will actually be okay.
All right, I almost want to ask you when you think the election is because of the economy, but we'll do it in January. We'll get this panel back together and we're going to take bets. Anna Andrade and John Stevik, thank you both for joining us. Coming up, we're talking UK politics after a pretty busy week at Westminster. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Well, it's been a tough week for the UK Prime Minister Rishi Sunak, defending his actions as Chancellor at the COVID inquiry and facing down rebellion over his Rwanda immigration policy. Let's get straight to our UK government reporter, Emily Ashton. Emily, as always, thank you. So it seems that the Prime Minister will see out the year, but is he on borrowed time?
Yes, I mean, we saw this polling. He is now as unpopular as Boris Johnson was when he resigned. And that's a poll from YouGov. Not great polling for Rishi Sunak. And he's had a really difficult week. Started with COVID inquiries. That brought back the chaos of 2020 and how the government handled the pandemic in those early stages. And then this big vote on Tuesday, the second reading of his legislation on Rwanda to get asylum seekers deported to Rwanda. That's a really keynote policy, and he's really basing his premiership on it. And it did get through, but there were a lot of abstentions, and he lost an immigration minister on that the week before. So a very difficult week, and crucially, that is the first rung of a very long ladder to get that legislation through, and that is going to dominate the weeks and the months after Christmas, which is quite dangerous with Rishi Sunak, because really he doesn't want that to dominate just before an election, which is expected next year.
Yes, and again, there's so much speculation about whether it's in the spring, it's in the fall, and he's looking at polling, he's looking at the economy. I mean, when can we expect the election?
Well, it has to be held by the end of January 2025, but as you say, we don't exactly know when it could be. At the moment, the likelihood is autumn, October, November. But there is some speculation about May. Now, he might want to go earlier to maybe surprise Labour and to hold it as kind of a take-back control election, like these judges are thwarting us getting our legislation through on Miranda, and the elites don't let us do what we want to do, and he could do a kind of big election like that. But there is a real danger in that with his ratings being so low. Could he really win people over? He might want the numbers on the economy to get a bit better, and for October, November to be a better time. But also, it might be out of his hands if he gets a lot of rebellions on the Conservative Party side. He might have to go earlier than he wanted.
Thank you so much, Bloomberg's UK government reporter, Emily Ashton. Now, be sure to also subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday. Today, this is Bloomberg.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Fed Chair Jay Powell gives the clearest signal yet that its historic hiking cycle is over.
And a question of when will it become appropriate to begin dialing back the amount of policy restraint in place that begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
Next up, the ECB and the BOE expected to follow suit, holding rates steady. Stocks and bonds and currencies all surge as Wall Street goes all in on the great monetary pivot of 2024. But two titans have opposing views on where we go from here. And UBS steps up the efforts to claw back hundreds of millions of cash bonuses from Credit Suisse defectors. Be wary out there Marty has formed when it comes to people who leave the bank and their bonuses. 2 days that have changed the direction and the narrative of risk, possibly irrevocably, for 2024. Something shifted in the past 2 weeks to help the Fed to the point of where they talked about rate cuts. Exuberance, euphoria, call it whatever you want. But a 30-bip move yesterday was the best day at the short end of the curve since the SVB crisis. So we're all in on this pivot this morning, and the bulls are running. The Fed is now really gripping the market. The market is pricing double what the Fed's guidance is. 150 basis points of cuts. We are sub 4% for the first time since late autumn. But the titans of the bond market going head-to-head. Gun luck versus gross on how low yields can go. Gun luck says 3%. The slowdown is there. That gives you a lot of headroom. And gross says 3%. It's farcical, dear boy. To the dollar. Down goes the dollar, up goes the yen in a pretty triumphant style. This is broad dollar weakness. It's pervasive and most pervasive in the yen. Taking out the 4-month high, the market, as I say, now sees 150 basis points of cuts. That makes the Bank of Japan's job so much harder. Crude just gets a lift from the overall energy of the market, so to speak. There's risk-on narrative across assets as the Fed does its pivot. There's a drawdown in U.S. stockpiles. They dropped for the second week in a row, Danny, and that's almost double the amount that was estimated. But it is a pervasive risk-on mood. The question is there enough liquidity in these markets to hold it up? It just takes one little bump to spoil the party. Danny, good morning.
You're right. It's silly season for these markets considering it's December when liquidity tends to be low. But what an exciting 24 hours, Manus. If that wasn't the pivot, I don't know what was. From the summary of economic projections to Fed declining to bat down any concern he might have about a market rally. So stocks played along with the rest of your risk assets, Manus. S&P futures again are higher today, up 0.2%. We are on track for the highest close for the S&P 500 in quite a bit, but already the total return index for the S&P is at a record high. The Dow, for those of you who still follow along, is at a record high. And if you look under the surface, it is those economically sensitive stocks which outperformed yesterday, those ones that had been lagging behind. Russell is almost in a bull market. VIX, that also dropped significantly lower. We're below 12%. We are now at a 4-year low. We're going to talk to Amy Wu Silverman for RBC later in the show, and she says it's like buying insurance for your house catching on fire. You might not think it will, but you should buy it. But this market, it ain't buying it. Finally, Manus, this rally, it is global. European stocks also up more than 1%, as are Asia stocks. The question also shifts today to do the ECB and the BOE follow along. The market to this point, Manus, thinks that they do. Let's go into the terminal chart because the pricing we have seen for cuts has really picked up steam since yesterday's Fed decision. We see 6-quarter basis point cuts from both the Fed and the ECB. The BOE's around 130. But TD, the strategists over there, Manus, say that it's a mistake for the market to extrapolate what happened with the Fed for the rest of these global central banks. Unfortunately, that's exactly what they're doing.
And it is completely inappropriate because it is about the PCE deflator. We'll talk about that with our guests in the next moment, which is it's a review of where you are in the disinflation narrative in the United States of America relative to the inflation narrative in the UK, less so in Europe. Go to Mohamed El-Arian's tweet from late yesterday evening. We have this turbocharging in markets, which we have very comfortably covered. But I'm drawn to the point, of course, he says it's about holding control of the narrative, which they've now completely let go of the reins on that. And he says you may well need to see other Fed members come out and pull back a little bit from this louchening that Chair Powell has unleashed on the markets. But let's stay with that pivot, Danny, because it's a signal. It's a pivot that the tightening policy is revising, and part of that revision is the PCE, with the year-end revised to 3.2%. 2024 is revised to 2.4% and 2.2% for 2025. Let's bring in Ludwig Subran, Chief Economist at Allianz. Ludwig, good to have you with us. So from your point of view, it is about the disinflation narrative that perhaps allowed them to validate this pivot. And that's what sets the Fed apart from the others, isn't it?
Well, it certainly is the main reason behind what many have considered the FOMC meeting yesterday to be very dovish. I think it is because the disinflationary pressures in the U.S. are strong, are there. It was a textbook, spike in inflation from very strong aggregate demand push, a lot of money put into the economy to avoid recession, bankruptcies, and unemployment after COVID. And now we see that this has been drained out. The liquidity has been drained out somehow. And now, I think the financial monetary conditions are more or less in line with what I think Chairman Powell think is good for the U.S. economy to deflate. And so as a result, now markets are going crazy again on the other side, and they are pricing in 150 basis points of cuts. So I still expect only 100. I still think that there is a lot to do out there, and the U.S. economy is still relatively strong, and we see some of the transmission channel a bit hampered, I would say, by the very profligate fiscal policy. But it's good to see that there is pivot now. And I hope it's going to bring some, I wouldn't say, lesser volatility, but at least some form of forward guidance a bit to what can the market expect in 2024.
Yeah, and we're seeing some of that reaction right now in the charts. I mean, the drop in that 2-year yield at 10 basis points is something you usually see in a crisis like SVB. But Ludo, I was really struck by Nick Timiraos at the Wall Street Journal giving Powell a chance to respond to what this market was doing, asking him about financial conditions. I mean, this was a very different Powell than we've seen in past pressers. He was unbothered by it. Do you think that's a mistake on his part?
Look, I think it's, this multifactorial, equation is very complicated now for Chairman Powell. And just throw into this the U.S. elections in 24. I think he knows that there is a lot of trade tightening. I think there's been a lot of discussion about this term premium. And now it's indeed about the disinflationary forces taking the front part of the stage. And so he had to focus on that part. But I would say, for me, what is going to be very interesting in the next couple of quarters is what we see in the transmission channels, especially housing and corporate lending, because it's almost too good to be true as we speak. Yeah.
So where are you on the timing of this, Ludo? Because the notes will come fast and furious. Goldman's this morning talking about, again, they focus on the same as you, the disinflationary narrative from the PPI, and they go for a fast and perhaps front-loaded. How fast, furious, and front-loaded will Ludo go this morning for Allianz? Come on, beef up the market, rev it up.
I'm not as fast and furious on disinflation because I think real wages are going to turn positive again in the U.S. And I think to a certain extent, I still believe there are reasons to be a bit worried about what's going to happen on the all these deficits into the economy is really pushing up prices for me a bit too much. I'm always a bit concerned about. I'm positive on the disinflation coming from the supply side. I'm less positive on disinflation coming from the demand side. So we need to be cautious. That's why we have only 100 basis points, and that's why we start only in June. I think markets is really divided, and people are starting cutting as early as March, right? So that's where I think they get it wrong.
Call it the way that it is. They've got it wrong. Good lad. Allianz versus Goldman's.
Hang on. Okay, before I get to Lagarde. No. How do you respond to that, Ludo? I need to hear a response to that before I go to Lagarde and Bailey.
Look, Goldman has been switching from recession to no recession in 6 months, faster than UK has been, putting his gun. So I'm just waiting for the next update on the scenario. We're a bit more steady on the German side. I've had the same scenario since July, and I've been talking about the last hike and all of that. And so I'm still positively surprised by the soft landing narrative to be holding strong that much. I still, 24 will be a muddle through, and it could be tiptoeing in that territory. So we just need to keep that in mind. But so far so good, and I think it's good to see that central bank made it happen. It was a 2-year inflation spike, and all in all, it's actually going okay. But the reasons why it's going okay is mostly, again, because of the fiscal deficit. That the main difference between this hiking cycle and the past 9 hiking cycles of the Fed. So we just need to acknowledge why we see soft landing in the US, because that brings us to Europe. We don't have, as you know, this fiscal profligacy.
Oh, there's the segue.
It's just what happened with the German budget. They have to save 20 billion for next year. So we have a different,
in all seriousness, how do Lagarde and Bailey respond to this? Because if they do anything except endorse cuts, they're going to sound a whole lot more hawkish than the Fed.
Yes, that's coming. I think they still need to push back a bit because of the risk of dissensus. I mean, the BOE from the Bank of England is the one that is going to pivot the latest. So I think certainly somewhere, towards the end of 24, because they have this risk of wage price spiral, which is still hanging over their shoulders like a Damocles sword. I think on the ECB, the big problem is that we already have a recession in big countries, like, Germany. And so the problem is that a lot of market participants are expecting them to even cut before and to cut even more. That's why we have this 140 basis cuts priced by the market. It's really 50% of people saying they're going to cut later, towards, July or so, and only by 50 basis points. That's where I stand. And then you have people that are basically shorting Europe and saying it's going to be a 200 basis points cut, and they have to start as early as March because they're already in recession. I think that's why they need to be super cautious with the wording. But they have to, it's what Powell did. You have to talk about what the street talks about. Otherwise, you look like you haven't gotten the memo that the disinflation forces are also very strong in Europe. Not as strong, but they're there.
Yeah, well, I mean, I guess Manna said they let go of the narrative in one way. You could say, hey, they've reclaimed the narrative back. They're making the market's narrative their very own. Hey, Ludo, it is so wonderful to speak with you on a day like today. Please come join us again soon. Ludovic Sabran there of Allianz. All right, let's get to some of the other top stories that are trending on the terminal this morning, because there are other stories. Vivendi is considering splitting up its media and entertainment empire into 3 separate entities. The French company says it wants to address a, quote, high conglomerate discount. Shares of Vivendi jumped as much as 12%, now up 8% on the news.
6 portfolio managers are said to be leaving the billionaire Izzy Englander's Millennium. All were based at the London office. Frequent departures and hirings are common in multi-strategy hedge funds, which have tight risk limits and little tolerance for losses.
BP's former CEO, Bernard Looney, will forfeit as much as £32.4 million in pay. Looney resigned in September because he lied about his personal relationships with other employees. In a statement, the company said he knowingly misled the board and that this amounted to serious misconduct.
And Bloomberg News Morning Consult poll shows Donald Trump is pulled ahead of President Joe Biden in the must-win Michigan state. This as voters remain pessimistic about the U.S. economy. Meanwhile, the U.S. House Republicans have voted to authorize an impeachment inquiry into President Biden. The party line vote sets up a high-profile clash between Congress and the White House as we enter the 2024 election cycle. Danny.
Well, coming up, Manus, we have some juicy pay stories before you. Before its collapse, Credit Suisse paid hundreds of millions in cash bonuses to retain deal makers. UBS now, Manus, is trying to get that money back.
Absolutely. And a little bit later in the hour, we speak to Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. What's the call for 2024? There was nothing better than just buying outright SPOOs. So much for options. We'll talk to Amy in just a moment. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
It's Bloomberg Brief. I'm Danny Berger in London. Manus Cranning is in New York. UBS Manus, they're ramping up its effort to claw back hundreds of millions in cash bonuses paid out before Credit Suisse collapsed. Tom Metcalf joins us for more on this Bloomberg scoop. Tom, first of all, is this normal? How common is this, and how difficult will it be for UBS to do?
So it's definitely a strategy that banks, have used for a long time. But normally it's like deferred shares because they're very easy to cancel. What's interesting here is, quite deliberately, Credit Suisse went out there, threw out something like $1.5 billion to various people they were trying to keep, mainly deal makers. But they gave it in the form of cash. And now the challenge is, that cash has gone out the door and they've got to get it back. And obviously legally there's various structures they can do. But as you can imagine, some deal makers are probably, pretty canny and going to do their best to keep it,
Yeah.
Takes me back to a line from Axel Weber. I'm just looking it up here. A number of years ago, this was around the time Orchel left the bank, which was Ermotti's right-hand man at the time. He said, you lead, you lose. There you go. You go out the door. Yeah, what you need on those options, I can remind you both being in banking, you just need a vesting moment. And then it's like this heavenly moment, the vesting moment for your stocks. Let's talk about the strategy in China. They're combining the entities, but then we've got Credit Suisse shifting gears in terms of their exposure in China. How does that play out for UBS in terms of the shift? They're disbanding in China the Credit Suisse size. What does it mean?
Yeah, so I think it makes sense, right? You don't necessarily need two units. But I think the sort of optics and the messaging here is quite interesting. It does speak to the fact that, China increasingly, for so many years was seen as this great sort of future profit center. Instead, the entire Credit Suisse wealth unit is being disbanded. And while UBS will still obviously be in the country, will still have, a hefty wealth presence there, the fact that they are kind of pulling back at least from that one unit shows that China is probably not the kind of, supermarket that people used to think it was.
And it's interesting, going back to the earlier conversation about UBS, about clawing back pay and waiting for that vested moment, it seems Citi, not exactly, but is kind of doing the opposite and giving people early partial bonuses to be like, cool, you've got your money now, please leave, trying to get people to leave the firm earlier. How does this kind of fit into the overall strategy of what Citi's trying to accomplish?
Yeah, so I find this absolutely fascinating. So basically they're going out there and to certain people who are going to be affected by this restructuring saying, look, if you're able to leave now, we'll give you a big chunk of that bonus, and otherwise you're going to have to run the risk of just being, sort of classically cut. So yeah, the way it fits in is it's very focused, very targeted. It's not like anyone can just sort of put their hands up to get this pretty good deal by the sounds of it. But I think it does go to show just how sweeping those changes are, and this is going to be running and running for Citi. They're clearly reshaping that bank in a pretty significant way.
Tom, thank you very much. It's all about keeping the rainmakers there. And it's on a day, we'll talk more about it later. BP, Bernard Looney, forfeiting £32 million after he resigned. But that's all about corporate governance. Bonds. Let's have a look at that. We're on a roll. We're on a ripper. These yields are dropping sub 4% in U.S. Treasuries as they discuss rate cuts for the first time at the meeting. Something big change, Danny, in the 2 weeks, as you say. You're looking at German bond yields fall. What will Lagarde do in terms of perhaps restraining the enthusiasm of the bond market for 6, if not near a 30% probability of a 7th rate cut? And UK gilts down as well this morning in yield, up in price. What will Bailey do for the pushback? And there is this global narrative for 2024, yields collapsing around the world, and this as the SNB drops the wording of a possible future rate hike in their statement. Yields fall in Switzerland. It's a global melt-up in markets for risk.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It's Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger alongside me in London, patiently waiting for the Bank of England. But we're going to talk about two big titans of the bond market. This is, of course, Gundlach, Gross, and Goldman Sachs, not to be left out of the foray. I want to focus in on what Gundlach said. We mentioned it at the start of the show. He says we could make it to 3% on these bond yields. We're sub 4% at the moment, 3.94. Remember 5.02? And this is what he says. We've broken down the trend lines. There's a lot of room left to get to that lower bound of 3%. By the way, Danny, he's also calling for a full 200 basis points of cuts next year. The market is at 150 this morning and bid. That is double what the Fed guided.
You know why I love this? Because there was that weird back and forth between them earlier in the year and like who was the actual bond king. Well, Gross very much so disagrees with Gundlach. He calls it farcical to say that we're going to go to 3%. On this, Manus, he tweeted it out or X'd it out, whatever it's called now. Just using simple math. If Fed funds rest at 3%, then 10-year average term premium of 1.1 indicates at 4% that we are there. But I mean, the whole thing, even if we are there, even if it has 4%, if you look from back, take a step back, we were just at 5% in October. Moving to 4%, moving to 3%, all of them are quite incredible moves if you think at where we started 2023.
You remember the frenzy in the early part of the autumn? I just arrived in America. People were talking about 6%. You Jamie Dimon, you know, en passant on a podium.
So
it
true.
wasn't a call. It wasn't a, you know, a Jamie Dimon says we're going to hit 7%. But he was flying the kite that inflation was still very much a second round effect that could come to play. And that takes us to Goldman. So today what we've established on Bloomberg Brief is we have Allianz versus Goldman's. I mean, scathing. I got to say, Ludo was like, ooh, a gut punch there, which is, you know, they flip-flop quite aggressively at Goldman's. But they are out with a call, and this is Jan Hatzius at the team, Danny, which is they're forecasting 3 consecutive 25 basis point cuts, March, May, and June. It's going to be earlier and faster, and that's what Ludo pushed back at. He doesn't think it's going to be as fast and furious and front-loaded, perhaps, as the market does, and Goldman's, perchance.
Yeah, I mean, he sees about 100 basis points of cuts starting in June. And one of the other interesting things he alluded to, Manus, is that it's also an election year in the U.S. How does that impact the timing of how much and when the Fed cuts? In an election year, are they really going to go straight out of the gates and cut starting in the early spring, like Goldman points out? I don't know, but it certainly is a factor for what the central bank does for timing.
And he also did allude to the fiscal situation in the United States of America, but there's been no indigestion in those bond markets so far. Retail sales, Danny, is out today, and the jobless claims. That could help shape a new narrative today. Danny.
Yeah, and in the meantime, currency is off to the races. Dollar weekends, yen surges as much as 1% versus the greenback.
venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Fed Chair Jay Powell gives the clearest signal yet that its historic hiking cycle is over. Next up, it's the ECB and BOE. They're expected to follow suit, holding rates steady. Stocks and bonds surge as Wall Street goes all in on the great monetary pivot of 2024. But two titans have opposing views on where we go from here. And UBS steps up efforts to claw back hundreds of millions in cash bonuses from Credit Suisse defectors. It was a remarkable decision and a remarkable press conference, taking together the summary of economic projections and a Chair Powell who did not push back against this market. It is clear that the pivot is in and the market is taking that and running with it. So the superlatives to look out for: the U.S. stock market and the S&P, it's at a 2-year high. Futures continue to move higher, up about 1/3%. The total return index is at a record high. The Dow is at a record high, and small caps surged yesterday, almost now in a bull market from the October low. The VIX index, this is below 12%. We're going to be speaking with RBC's Amy Wu Silverman in just moments, who talks about the importance of buying, if you will compare it to this, insurance for your house when it comes to catching on fire. You may not think it will happen, but you do it anyway. Nonetheless, VIX at a 4-year low. Finally, European stocks, Manus. Look, this is a global rally, right? You have European stocks up 1.6%, and Asia equities, those are up about 1.5%. So no market is immune from the Powell pivot party.
No, not at all. There's a lovely alliteration for you. The Powell pivot party. Well, it delivered an exuberant response in the short end of the curve. Two's dropped by 30 basis points. One of the biggest one-day moves that we have seen since the SVB crisis. So that kind of momentum, the drop in yield, it continues. It's coming off just its lows this morning. Just speaking to a couple of people on IB, they're saying basically the rates market, people are lifting off their positions. They were long duration into this, both all the way across the curve, taking off their positions on Kiwi, on Noki, on SEK, and on ECB. And of course, we have the ECB and the Bank of England today. But this level of euphoria in the short end of the curve translates right the way across in terms of dollar weakness, in terms of bond strength. You're sub 4% for the first time since late August. The market is now pricing in the US 150 basis points of cuts. It's pricing in nearly 6 interest rate cuts from the ECB, nay 30% chance of a 7th rate cut from the ECB. Allianz have just been with us, and they say actually it's too much, too far, too fast, too aggressive. The Fed will go later than we anticipate. It'll be June. It'll be 100 basis points, as opposed to Goldman Sachs, who are saying they will go faster and earlier. And of course, Gundlach is saying that you could see 3% on the bond market. We talked that to death. Well, let's leave that there. The dollar is lower, the yen is higher. It makes the job of the Bank of Japan a heck of a lot harder, really, when it comes into next week. We took out the 4-month high on dollar yen, and we have this sort of all boats are rising in terms of risk, as you say, on the equity market, but also on commodities. The dollar is down. The oil is better bid this morning by nearly 2%, and a lot of that is also the Fed pivot, but also stockpiles dropping for the second week in a row at double the pace the market had anticipated. Danny.
And with that, Manus, it's not just cuts estimated for the Fed, it's now ECB and BOE cuts too. We were talking to Ludo, who said that, especially when you look at the BOE, for example, they have more work to do. Inflation is stickier. So it's also maybe a mistake extrapolating what we heard yesterday into today's decisions.
Indeed, and if you look at the inflation or the disinflation narrative for the UK and for Europe, obviously Europe is ahead of the UK, but what you have here is, as you say, can Bailey and Lagarde do anything but push back against where their market pricing is relative to the Fed?
Yeah, it's certainly true. Manus, I want to get back to the markets because, again, the movement in the VIX over the past week has been remarkable. We have gone now to sub 12%, 100 basis points of moves following the Fed. It was at a 2-year low, and now here we are with the VIX at its lowest in 4 years, on the cusp of what many people think will be a bumping landing for this American economy. Let's bring in now Amy Wu Silverman. She's the head of derivative strategy at RBC Capital Markets. Amy, I've probably said this line of yours like 4 times already today because I really love it. The way to think about this is fire insurance for your house. You may not think your house will set on fire, but if it's cheap, you buy it. So what's the risk now to have so many folks who are unhedged in this equity market?
Yeah, that's exactly right. And to some degree, I think that is the risk. So when you look at the options market, both the right tail, the upside, and the left tail, the downside, both are incredibly cheap. There's a lot of technical dynamics in our market right now that is keeping volatility suppressed. But one thing that's simply been true is folks have not been hedging. And you look, it doesn't mean that there's a greater likelihood that your house does set on fire. It's simply the idea that that cost of insurance is really trading at historic lows. And we always have the idea of unknown unknowns that could come into the market, in particular in an election year, in particular with 2 fronts of a war going on. And that's what we go into 2024 with.
Amy, good morning. Usually I'm the one on this show that has the glass half full, so I'm going to pivot to the glass resoundingly full as I go for a bit of Christmas cheer. Let's take the other side of that trade. Every guest we've had this week, yeah, you're right, Danny, I'm actually cheerful today, it's Thursday, have come on and they talked about this gusher of liquidity, both on the retail side, the institutional side, and in the money market funds. So you pick your number. It's anywhere from 6 trillion to 8 trillion, depending on who you ask. So let's take the other side of the trade. How expensive is it to buy further upside protection in such a rising melt-up market? How do I perhaps get some kind of scale on the upside through the options market if you believe liquidity comes in and the rate cuts get delivered?
So this is really fascinating. This is something we've actually seen if you look back to 2023, the beginning of the momentum rally, or when NVIDIA first reported earnings, you start to see those upside call cycles in the options market. So to give you an example, you know, when people need to jump into the pool quickly, they use the options market to do it. So you start to see that demand in the call wing of the options market really get bid up. What we're seeing right now, Manus, is that's happening in the small cap side. So essentially what it's saying is the options market sentiment is incredibly bulled up, but it's specifically bulled up on the idea that the market breadth, that the market widens. This was not true when we had other fits and starts, but it's very much true now in IWM, which is our small mid-cap proxy, and has continued to remain sticky for the last month or so, even after we've had a 10% rally in November.
You can definitely see that playing out in the cash market. I mean, you can see there the Russell 2000 futures are much outperforming. Yesterday, they jumped 3.5%. I wonder when it comes to some of the more quantitative, momentum-y following strategies, the CTAs. I feel bad at how I'm about to phrase this question because our last guest took a go at the Goldman Sachs economics team, but I'm going to have a go at the Goldman Sachs quant team. Goldman had said, regardless of what happens this week, that CTAs will be selling. The systematic traders will be selling. They're too long at the moment, so whether we rally or we don't, there's going to be selling in the market next week. Does that sound right to you? Would you agree with that kind of analysis? Or is it more like, look, we have this huge momentum flow. The momentum traders are going to glob onto that?
So look, I would say systematic flows like that, look, they can be accurate, but they're not the holistic flows that you see in the market. So for example, one thing I could see happening is if you continue to see that bid to the call wing of the options market, there are also other technical dynamics that happen in the options space. So dealers actually have gamma hedges that come on, which could force them to buy further shares. These are gamma cycles you've seen during NVIDIA. It's the gamma cycles we saw during the meme craze. So, when folks ask me about CTAs or vol systematic strategies, or a number of different technical factors in the market, what I would say is a lot of them, can be going in opposite directions. And what you really have to do is kind of look at the netted holistic liquidity that's coming into the market. My sense it's still going to be positive momentum, as we got kind of a momentous pivot from the Fed yesterday.
How dangerous, Amy, I'm going to take the other side of the trade. How dangerous is it at the moment to write put options? You've got such... we're gushing this morning, aren't we? It's superlatives. Danny's got more record highs than I know what to do with. I'm getting so excited about the short end of the curve. I think if I get any more excited, they'll run me out of the building. How dangerous is it to countenance that kind of... I don't know whether you do it outright as a naked trade, but talk us through your thinking, because a lot of people can get sucked into, I'll write some premium, it's a cheap trade.
It's not something that I would do. Let's put it that way. And that's more from a function of that downside put premium. It's just trading at historic lows. So so we call it downside skew, but that skew has really underperformed in the market the past 2 years. So it's more that you're not getting that much bang for your buck on it. It's not a trade that has a lot of meat on it. And then obviously, you could have the situation of a gap downside. Look, if you kind of take a 10,000 foot view and say, what is the least position scenario in the market right now from an options perspective? It's the idea that we have some sort of gap down. That's what people are not prepared for, and that can come very quickly. So, look, it's not something I would do. I'm sure there are folks out there who are doing it. It's those pennies keep going until that train comes.
Well, to that point, Amy, you wrote that not a single option strategy beats simply being long the S&P in 2023. Does that then continue in 2024?
Yeah, it hasn't been a good showing for us, has it? Look, I think those things are hard to say. I do think that there is kind of a reversion to the mean, not just in options, but in general. And we've had a severe underperformance, I would characterize it, since the pandemic. And I do think that as we normalize, that will start to change as well. So you've seen these volatility strategies that just systematically sell options. They're suppressing option volatility, and that's been successful. But then we do get these cycles, for instance, from 2017 to the beginning of 2018, where the market kind of shakes out of it too. So I do think we're kind of at the kind of further tail end of that rather than the beginning of something like that.
Amy, thank you very much. A good ballast to the enthusiasm on the superlatives there, the helicopter view from 10,000 feet. Get your insurance in. Amy Wu Silverman, our guest this morning. Let's check in on those markets. Do you want a little bit of insurance? Volatility, as Danny says, is at the lowest in 4 years. We've just heard from Amy, which is you want some insurance for the event of the house burning down. S&P is up a third of 1%. The dollar declines on the back of talk of rate cuts from the Fed. How soon, how fast, how furious? That is the debate. Good morning from New York. Oh, no, Danny, what's up?
The day's not over yet, Manus, because we have to talk about the ECB and the BOE. The Fed's decision checked off the list. What will Lagarde and Bailey do?
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I think the Bank of England, for tactical reasons, will want to talk tough near term in order to try to put a lid on pay deals. Many pay deals are set in the first few months of the year. The Bank of England will want to talk tough in order to try to ensure that firms set pay deals for the coming year at a significantly lower pace than what we've seen in the last year. Remember, the UK has a much more sticky domestic paid-driven inflation process than either the Euro area or the US.
Former BOE policymaker Michael Saunders speaking to Bloomberg's Lizzie Burden ahead of the Bank of England rate decision. Now, let's get to Lizzie and our other reporters around the world covering this. Not only do we have her, we also have Maria Tadeo at the ECB in Frankfurt. Lizzie, if I can start with you, because I'm looking at this UK equity market and gilt market, and we're looking at a drop of 17 basis points. The market has certainly decided that the BOE is following in the Fed steps, but will it?
Well, clearly Michael Saunders doesn't think that it should. He thinks that Andrew Bailey should leave one hike on the table. But as you say, it's going to be a really difficult message to deliver when markets now are expecting 5 cuts from the BOE next year. I was also speaking to Martin Wheel earlier, the former Bank of England policymaker, who in fact Michael Saunders replaced on the Monetary Policy Committee. And he too thinks that the Bank of England should inject caution about this rate-cutting narrative. So we are expecting a hold today. The question is, how much can Andrew Bailey push back against the calls for cuts when he doesn't have a press conference, he doesn't have a dot plot ever, and he doesn't have a forecast today. So it's going to be extremely difficult as well when you've had that softer than expected GDP print yesterday too.
Yeah, I mean, that is the backdrop, which is a stagnation nation with rising wage inflation. So it's diametrically, it's completely different scenario to everybody else. There's an instant alliteration that I didn't even think I could make up. But that is the conundrum, isn't it? The question is then the hawks that are left there. I mean, we've got this pivot party globally, but you know, is it stagnation nation? Is that what emboldens 157 basis points of cuts?
Well, you will have, we expect, lots arguing that on the committee. But then if you look back at the last decision, there were 3 hawks who might survive to today, and they were Catherine Mann, Jonathan Haskell and Megan Green, they'll be telling you, Manus, inflation is still twice the target, more than. You've got this wage growth, as you say, over 7% for many months. That's not consistent with the 2% target. And don't forget, we just had that £21 billion of fiscal stimulus in the form of the autumn statement, including personal and business tax cuts. So they're going to probably want to stick with the higher for longer narrative. It's just whether the market will buy it.
Okay, let's see. Let's see how the pushback comes. Lizzie, thank you very much. Let's pivot to our very own. By the way, that Bank of England decision, Lizzie will be covering that team coverage, 7 a.m. Eastern time. To Maria Tadeo, we haven't seen you for a while now, Maria. The ECB brings you out. Brings you out on this winter morning. Here is the issue for Lagarde. A couple of weeks ago, she said in the not too distant future, we would talk about the phase out of reinvestment from PEPP. That is the single biggest lever that she possibly has to try and quell this 6 rate cut that's projected by markets, isn't it?
Yes, Manus. And by the way, I've seen now a number of central bankers exit the building, including the German central banker, Mr. Nagel, which means today's decision is basically done. And as you say, when it comes to the decision itself, well, everyone is expecting that the European Central Bank will hold. If anything, the zeitgeist has now fully moved from this idea of higher for longer, higher rates to cutting rates. That is really the zeitgeist that you can really feel in the central bank. On top of that, as you say, there's a question about the PEP reinvestments. Remember, she conceded in the previous meeting this was something the European Central Bank was looking at. Of course, that would mean bringing it forward, accelerating QT. Some argue the European Central Bank has to do that just purely because it needs to fully align now its monetary policy. So those are issues that could come up today. But the focus, and this is the problem, this is the issue, when you do a monetary policy decision the day after the Fed, for this European Central Bank, it will be about, do they want to cater to markets, concede that a pivot is happening now into cuts, and what that entails, or actually do you get ahead of a European Central Bank who is still fighting and pushing very much to delay that chat until at least the start of 2024. Remember, behind closed doors, the European Central Bank is still concerned that cutting too soon, if they get pushed into cutting too soon, that could be a policy mistake. If we do see that inflation does not go back down to 2%, that is why also the forecast today will be incredibly important.
What might we get from that forecast, Maria? Because, I mean, we saw with the Fed how important their summary of economic projections might be. So what are the details we're looking out for when it comes to the ECB?
Yes, and look, when it comes to a forecast, you can get it right, you have to tweak it, change it, and we know that they're not set in stone, but when it comes to a central bank, especially for the European Central Bank, this is about setting the narrative, and it explains to some extent to markets what they're thinking and why they're doing what they're doing. Their data says X, Y, and Z. Now, today, of course, the focus will be on inflation, especially when you look at numbers like 2024, 2025, but also in particular when it comes to growth too, because remember, there has been criticism, and I know that Peter Pratt will be on the show, he has said this too, that the European Central Bank has a tendency perhaps to overestimate the resilience of the European economy, and they're not fully up to date with the velocity in which the inflation could go back down to target. Of course, that is crucial, that landing zone, when it comes to setting the first rate cut. And if you look at what the market has priced in, by now more than 100 basis points of cuts from the European Central Bank, they believe it's either June situation or the economy gets really bad, and then you may even go for an early one in March. So the framework, the forecast, will be key in this narrative.
Yeah, and I gotta say, I mean, Lagarde's task made so much more complicated by what Powell did yesterday. Maria, looking forward to your coverage of the ECB decision. That's Maria Tadeo, Bloomberg's Europe correspondent. And she's, of course, going to bring us that decision. 8:15 a.m. Eastern is when we'll get that, followed shortly thereafter by Lagarde's press conference. Manus.
Yeah, well, the euro's trading at 109.08, so it's a little bit better bid on the back of the weaker dollar. Coming up, we'll take a look at some of the other market-moving events throughout the day. Some stocks on the move, Danny.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
It's your post-Fed Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Let's get you set up for a very busy day. Here's what's ahead. We have the Bank of England kicking off with a rate decision at 7 a.m. Eastern Time. Then it's the ECB's turn. That decision is at 8:15 a.m. Eastern, followed by President Lagarde's news conference at 8:45. Then over in the U.S., retail sales and initial jobless claims, those will be out at 8:30 a.m. Another huge day, Manus.
Indeed. Let's get a few of the movers. Now, you've got Berkshire Hathaway. This is Warren Buffett backing Oxy, O-X-Y, $590 million. So, yes, a stock purchase comes after, and this is after Occidental, Danny, agreed by the Permian Basin producer. Remember that deal, Crown Rock? That's one of the biggest energy deals of 2023. So that's a real backing by Buffett. A lot of alliterations today, right?
I personally love it. It's like poetry watching Bloomberg Brief. So good. Yeah. Okay, so Adobe. This stock had been one of those stocks that got a boost from AI, but now that boost is over. It's saying that it's going to take longer than expected to get all of that AI mumbo-jumbo done with. Annual sales at the same time. Wow, I sound like Tom Keene. Geez. Annual sales outlook also falls short of projections. All of that resulting in a downdraft. I can't even finish this now. I've lost my place. It's down 6%, Manus.
What was your fact? I mean, you found a fact of the day, and you know.
Yeah. Oh,
I'll give you the fact of the day because I'm facted out.
Thank you. I have too many today. Okay, so Apple not moving too much in the pre-market, but it did close at a record yesterday, despite the fact it had been hit by an EU antitrust order. It has to do with this overall market rally. And the best fact, Manus, is that it's now almost bigger than the entirety of the French market. Its market cap is 3.1 trillion. France is 3.2.
Do you feel a cathartic moment there now that you have contextualized?
Yeah, I feel better.
You've contextualized the size and the scope of Apple relative to the French economy. The question is, of course, you know, where are they going to sell the most iPhones when it goes forward? But we close with the bond markets, superlatives of the day. The biggest drop at the short end of the curve, and right the way across the curve since the SVB crisis. We're sub 4%. Will that endure? Danny?
Yep, but the rest of the market follows. Is it a mistake to assume so? Ludovic says that the ECB, the BOE, they'll need to push back.
economics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Question of when will it become appropriate to begin dialing back the amount of policy restraint is clearly a topic of discussion.
There's no question that the Fed showed its cards here. They're very excited about the fact that inflation has come down.
They've had decent growth, unemployment rate stable, and inflation's come down a lot. And that's basically as good as it can get.
This is a green light for investors. This bullish sentiment can go on for a while until we get a new round of economic data.
The market is really taking this to the brink here, and I would be inclined to go the other way.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
12 hours later, we're all still lost for words. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P is positive again. The bond market is still rallying. Yesterday on the S&P TK, we closed north of 4,700. 4,700 is the year-end price target over at Goldman Sachs for next year. Not this year.
We're not within reach of 5,000, but on Dow, 37,000. Futures already 37,577. Do we get 38,000 Dow points today with a lift? The most distressing thing yesterday was the Arsenal placard behind Greg Peters' desk. I mean, that has to stop.
I missed that.
I didn't see that. We can't book people like that. I mean,
Arsenal's doing better than that.
It was too emotional. But what I'm really interested, John, is how we open days. Two things. What do money market funds do over the coming days and weeks? Does the yield come down? Where does the cash go? And the other was the massive, obvious margin calls. How many people got run over yesterday? I think that will be a story for into the year end in Q1.
Absolutely steamrolled. Absolutely steamrolled. And here are the changes from Jan Hatzius and Goldman Sachs and the team over there. We now forecast 3 consecutive 25 basis point cuts. They start in March, continue in May, and go on to June to reset the policy rate. There were big questions yesterday about Chairman Powell and whether, Lisa, he would remove the punch bowl. He didn't remove the punch bowl, he spiked it and then turned up the music, and it was party on.
I mean, honestly, if anyone was expecting pushback, what they got was the basically declaration of victory, because what he said was nothing in terms of pushback to Nick Timira's question about market conditions and financial conditions easing. He didn't seem to address it at all. He didn't seem to address concerns about the fact that that could make their problem more difficult. He didn't seem worried about inflation anymore, and the result is the chances of a March rate cut went from less than 40% to about 85% like that.
So what on earth changed in less than 2 weeks for Chairman Powell? Chairman Powell, December 1, here's the line. It would be premature to speculate on when policy might ease. Not even 2 weeks ago. 2 weeks later, the question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now in the world, and also a discussion for us at our meeting today. Ramo, what happened?
I'll let other people do conspiracy theories. What I personally think happened was the data came in, and actually, if you look at a 6-month trailing level, you're looking at inflation that actually comes below the Fed's target at a time where Fed Chair Jay Powell is no Volcker. He doesn't have the heart to try to hurt this economy in an effort for some sort of decline in inflation that we're already getting.
I'd suggest we're going to talk to Anne-Marie Horton, Bloomberg Washington Fed reporter, here in the coming weeks and months. They got 3 meetings out on where maybe we thought they would be. 2 meetings, 3 meetings, 4 meetings into 2024. You mentioned the party and they spiked the punch bowl. I mean, let's be honest, Jerome Powell's a massive deadhead, and there's no question he was singing A Touch of Gray yesterday from the dead, and the answer is he's worried about the guy with a touch of gray, which is President Biden. I'm not saying I agree with that, but I'm saying what he did yesterday for Vice Chair Biden was a gift.
A massive gift.
Yeah.
And you start to consider the political calendar going into next year, Tom.
We are not going to do that, but we'll let Anne-Marie do
We'll
that.
ask the question for sure. We'll ask that question in a moment. Instead, he's going to stick around and try and answer it. Don't worry, I'm not going to ask. Equity futures on the S&P just about positive. Here are the scores. We're positive by 0.2%. Yields are lower by 7 basis points. Your 10-year, let's sit on this. Your 10-year is now 3.95. We have a 3 handle.
Nailed that.
The 2-year, Lisa, down 10 basis points again today at 4.33. The 2-year at its peak, October 19th, 5.25.71. We have dropped almost 100 basis points to the front end of the curve, Lisa, in less than 2 months.
Can we sit on this for just a half a second? To me, the fact that we saw more than a percentage point decline in the 10-year yield in less than a month, should that raise some concerns about the structure of a market that is supposed to be the most liquid and the deepest, the benchmark rate for all other asset classes? I mean, honestly, that to me is one of my big questions.
George Concalves of MUFG, what does Chairman Powell know that we don't know? Look, I know people don't want to engage in conspiracy theories, but people will. When you have an about turn, like the one we just saw from the Fed chairman in less than 2 weeks, people are going to ask, what was that about? What was that about?
Honestly, let's ask Christine Lagarde, because she's up next and she's going to have to follow the act. Bank of England rate decision comes at 7 a.m. The ECB rate decision comes at 8:15 a.m., followed by that press conference with Christine Lagarde. Does she echo what we heard from Fed Chair Powell? It has become apparent with all of the economic data that disinflation is fully underway, blah, blah, blah. We've declared victory too. Unlikely, but let's watch this, and I'm curious about the euro and its response. 8:30 a.m., a slew of economic data, November retail sales and initial jobless claims. November retail sales will be important. To your question about what does the Fed know that we don't, Fed Chair Powell did not engage with the question of a greater weakening in the economy. He didn't really engage in much potential pushback to anything that he was putting out there. But here's the question, right? If we start to see a real deterioration in retail sales, does that point to something different? And after the bell, these are the earnings. Would you like to continue?
No, I think on retail sales, Lisa, it's really, really important. It's a nominal statistic. David Rosenberg in the last hour has tweeted out about the complete focus on nominal GDP, animal spirit. Did he know those numbers yesterday? I don't know. It's a key question.
Meanwhile, I do think that the earnings of a lot of companies are going to be particularly interesting. Costco and Lennar coming after the bell. We talk about Magnificent Seven, but Costco shares are up more than 40%, and Lennar shares, that home builder, up more than 60%. So it's not just the high flyers. I think that's interesting.
Amazing. What a 24 hours, what a couple of months. Joining us around the table, Ian Steely, International CIO within the Global Fixed Income Currency Committee Group at JP Morgan Asset Management. Ian, good morning to you.
Morning.
What changed for the Fed chair in 2 weeks? What changed for you?
It's a really, really good question. I think Jerome Powell is fixated on delivering this soft landing. And I think what's changed is the inflation data is coming down. They are seeing good evidence that that job is done. And they are particularly worried that they're in restrictive territory. And I think over the last 2 weeks, what he was probably doing was making sure that the rest of the committee were going to be on board with what he was going to do yesterday, which was obviously do the pivot and get the markets excited about that. But I think we've definitely shifted from where we were earlier in the year, where people were concerned about growth slowing, but inflation being too high for the central banks to be proactive. Inflation's coming down. The central banks can now be proactive. They can try to deliver this soft landing.
Committee's on board, one, without a doubt. We're thinking about rate cuts. The market's moving on. When do you think we cut first? March? Is that when it comes now?
I still think it's going to be dependent on the data. I still think that they will be looking to keep rates a little bit higher until they're fully committed to having inflation coming down. But if the data continues to weaken and we see those private job pay growths going down, there's no reason they won't be cutting in March. If you think about historical cycles from final hike to first cut, it's not typically not that many months. And if the final hike was in July, then actually March doesn't seem unreasonable.
I think the synthesis of JP Morgan and this can be really valuable. The weekly prospects we'll get from Michael Feroli Friday evening will be widely anticipated. John Farrow mentions a 10-year yield 4.32% in 11 basis points. Moments ago, I got the real yield from a 185 down to a 1.76 on the 10-year real yield. What happens in your world when the money market fund comes down? I've got a quote, I think it's from BlackRock, 5.24%. What happens in a 499 money market fund, a 450 money market fund? That wall of money, where is it allocated across the JP Morgan world?
I think that wall of money is going to come into the bond market. And I think what we heard yesterday was probably the green light for a lot of those investors. I've been speaking to investors over the last few weeks, and they've acknowledged that bonds look attractive, growth is slowing, but what they really wanted to see was that pivot from the Fed. There were still a lot of people that have been in bonds this year, have been a bit frustrated for the first part of this year, and they were still concerned that they had a tightening bias. If that tightening bias is gone, the next move is cuts. That money is going to flood into bond funds.
And the game here, Lisa, is great. Does it keep going from here, as we see this morning? I guess presumed. Or from what we heard from Greg Peters yesterday of Arsenal, and Greg Peters made it real clear he doesn't buy this. He's looking for a pullback, yield higher, price lower to step in. That's the conundrum this weekend for fixed income, isn't it?
Which is the reason why, Ian, I think it's interesting that you seem to have more conviction that the wall of money is going to keep going into bonds. Are you basically saying that the long end is a screaming buy at this moment, given the pivot from the Fed?
So I think, firstly, that pullback would be great. I think everyone was actually looking for that pullback this week. We had CPI. We were apparently going to have a Fed that was going to push back on the easing in financial conditions. It hasn't happened. Are we going to get that pullback, or actually do you just need to look at the bond market today and say, you know what, 4%, that's not too bad. Most people would have bought that at the beginning of this year, and the data is slowing. The inflation prints are lower. Where on the curve, I still think you do need to be slightly concerned about the supply that's coming. So more intermediate bonds make a lot more sense, I think, from a kind of risk reward standpoint. But we are in an environment which should be pretty good for the bond market.
What I find interesting is that everybody was set up with the ECB making the first rate cut next year and the Fed following because the U.S. economy was in a better position. Yesterday kind of upended that, and we're seeing that in currency markets with the euro strengthening quite considerably. I'm just wondering if this is the most out of consensus trade that you can lean into, that the dollar is going to strengthen, the dollar is going to weaken and the euro is going to strengthen, with the Fed being much more aggressive on this newly Burnsian, perhaps, or just Powell-in Fed chair?
Keep going, Bramo.
I'm just crushing it.
So I think it's going to be absolutely fascinating how Lagarde follows this today, because if you just, like you say, if you just looked at both of those markets and you look at the Eurozone where growth is zero, bumbling along, and we've had this disinflation environment in Europe, which is becoming quite concerning to the state that Isabel Schnabel is saying the facts have changed. It's the ECB that should be doing this sort of pivot, not the Fed. So I'm going to be fascinated to see what Lagarde has to say
Didn't
today.
Chairman Powell just open the door wide open and say, walk in, please, your turn, you're next?
Yes, possibly. I mean, the ECB typically it does take more time to move to gain that consensus on board, but I think the consensus could also be there for the ECB. So I'm going to be interested to see whether they do follow Powell, and if they do, the market's going to be off to the races again.
Can the money that you mentioned earlier going to fixed income, which is clearly the first choice, does it also go to equity? And is the market getting out of front of the wall of money of May or June or July?
If the market can get convinced that they are going to deliver this soft landing, then yes, the equity market
with
also
ample GDP, even as they bring rates down.
Yeah.
Did you see in the GDP forecast yesterday ample GDP?
I think you're seeing trend-like GDP.
Fair.
Yeah, it's coming down, but it's not disastrous. And actually, if they generate this soft landing and we bottom and then start to move back up again, that's going to support all asset classes. We saw that yesterday.
You raised the important question, I think, just how data-dependent is this rate cut call now? I do wonder how data dependent it is based on the communication we got yesterday. What would need to happen between now and March, do you think, to make this one go through?
I think you need to see more continual evidence that inflation is slowing. We've got a lot of evidence.
So more of the same.
They'd like to see more of the same, and I do think you probably want to see a little bit of weakening in the jobs market. But what we also heard yesterday is those insurance cuts or those proactive cuts, it might be inflation dependent, and they might be comfortable doing that because they do believe that they are in very restrictive territory at the moment.
We sit here in 12 months. Where's the 10-year?
Closer to 3 than 4.
Okay, 395 right now, down another 7 basis points. Ian Steely of JP Morgan Asset Management. The Fed behind us, the ECB still ahead. For the European Central Bank, is the door wide open, TK, for Lagarde to do exactly what Chairman Powell did just yesterday?
Well, certainly not exactly, and I think she's got a whole different set of people around the table. I just can't believe she can do anybody can do the shock of yesterday. He could do it because he's got a vibrant, dynamic, technology-driven economy, and the United Kingdom, Europe, and Japan don't have that.
What if she came out and she said, well, I'm going to cut rates now? I mean, how could she upstage what he did, given the fact that they've got more reason to go first? I mean, that's basically what everyone's been saying.
I'm guessing a Bundesbank might have something to say about that.
They're not going to cut rates today. But
we'll see.
Yeah.
We'll see. The ECB a little bit later, the Bank of England as well. We've got to talk to a man who's absolutely nailed it over the last few months. Neil Dutter, Renaissance Macro, later this hour.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
A huge about turn from Chairman Powell just yesterday, sparking a big continuation of this rally. Equity futures right now on the S&P 500, the scores look like this. Futures positive by 0.3% on the S&P 500. The rally continues in the bond market. We have dropped by another 7 basis points with broken 4%, TK 395 on a 10-year, on a 2-year, 432.
Terrific analysis. Thank you so much for the comments yesterday. All three of us. It was great. We sleep here. We don't go to a hotel or anything with the 24-hour day we're putting in, and just great comments through the evening as we had a campfire and had s'mores. And what I would suggest, John,
I don't know what you're talking about. Carry on.
It's an American thing, John. It's like camp in America. You're 8
I get
years
that.
old.
Just don't know the relevance of it, I guess.
Mosquitoes.
You're still wondering these.
Here's the relevance right now for New York Wall Street, and a number of analysts have done a great job on this away from the economics, finance, investment. And I'm going to use Microsoft as the Magnificent 7 charge yesterday. Here's what happened yesterday afternoon is a lot of people got run over by Jerome Powell in the trade. On radio, I'm going to describe it is a normal trading day. John, Microsoft, Joel Fishbein at Truist coming out with a big buy-side call. Amy, give me that chart if you can on Microsoft here on television. And then a churn through the day. And then Powell spoke and the Magnificent Seven cratered. Why did they crater? They crater because when you are in stress and you have margin calls or maybe margin calls, you sell the best quality thing. It happens every time. And what we saw yesterday with the rebound after the calls came in, I think is profoundly important. It'll be fascinating to see what Magnificent Seven do today.
So I'd say it wasn't a major move, Tom. That's perhaps one explanation. I think what is more curious over the last month is that breadth has improved. And what you saw yesterday was a continuation of the bond market rally. And this for the banks. KBW Bank Index up by close to 4%. The regionals, Lisa, up by more than 5%. That's where the enthusiasm is over the last few weeks. Less of a worry about a hard landing. Much more optimistic, constructive about the prospects for growth next year with the Federal Reserve that's going to be cutting interest rates.
The Russell 2000 up 3.5% yesterday, just yesterday alone, just to give you a sense of that. And what we're looking at is this idea that maybe people are selling what they can in order to buy things that have better upside potential.
Anne-Marie's arrived. You might have heard.
Dropping my phone.
Drop your phone, that's okay. Emery Horton with us now, our Bloomberg poll correspondent here this morning. You okay?
Yeah.
Okay. I got a lot of political questions about the Fed, but let's get to the Bloomberg poll this morning. What is new about the poll as we go to January in the first races?
Well, what's new about this poll is that's the first time Trump has a lead ahead of Biden in Chicago, in Michigan. So he now has the 7 swing states, Trump does, that we have been polling. So in October, Biden still had Michigan, and now that goes to Trump. It's still within the margin of error, but what we do see is that Biden is losing support from these groups that he has to win. We're talking about Black Americans, young Americans, and women voters. So what you're going to see, though, is potentially, though, the fact that Biden could build on this. It's about bringing back in the people who voted for him in 2020. So it does look very good for the former president. On the economy, which still maintains the biggest issue for these people, people trust Trump when it comes to everything, not just kitchen table issues, but interest rates. Anything that touches the economy, they trust the former president. There's one piece of data in here, though, I think is very good for the Biden campaign, and that is the fact that while most swing state voters don't think the economy is moving in the right direction when it comes to the country or even their state, they have better and more optimistic progress about how their own economic conditions are, what's happening in their town, in their county. And that is something the Biden campaign could build on. We still have a year to go.
We've had a series of bad polls for this president. And this White House claims that they don't really listen to the polls or follow them. In fact, they might say it doesn't accurately capture the mood of this country. But what I'm capturing is a shift from this administration. Weighing in on Fed policy on Friday, the Secretary of Treasury doing the same thing earlier this week, and then a shift when it comes to views on Israel. And the division we knew that was happening privately, we're now seeing spill out publicly. Now, they might claim that these polls don't matter, but are these polls changing policy?
Well, this morning, when you look at the reporting from Political, they're saying that Vice President Kamala Harris is urging the administration, even having a conversation with President Biden about the messaging and also the conversation that needs to be happening with Prime Minister Benjamin Netanyahu about day 2. What happens next after the Israeli invasion of Gaza? They're concerned, obviously, about the humanitarian. So we have seen a shift when it comes to how this administration is talking about Israel. But also, Jonathan, when you're talking about the economy, Biden's quote on Friday was this: solid, steady job growth, like that we call that a sweet spot that's needed for stable growth and lower inflation. Quote, not encouraging the Fed to raise interest rates. This was very rare for the president to do this. And yesterday, Jonathan and I were talking about how in 1992, when George Bush lost re-election, he squarely blamed Alan Greenspan for that. He said it was because of the economy and the people weren't fearing the recovery because he was too late. He said, I appointed him and he disappointed me.
Okay, let's go there. Since you brought it up, does anyone actually believe that this Fed chair was somehow manipulated or convinced to shift his approach because of the administration?
Well, I'm not going to speak for what people think, but what I will say, too, it was a trifecta of everyone singing from the same tune, starting on Friday with the president talking about how we are in a, quote, sweet spot when it comes to inflation coming down and still an incredible job market. This administration loves to tout, that the unemployment rate has been under 4% for some 22 months. We heard that then from Secretary Yellen, and she is saying that she thinks the Fed is on the right path. And then it felt like from Jay Powell yesterday, a complete different tone he took than he did 2 weeks prior. He was almost embracing what the market has priced in, and that is for cuts next year. So the timeline for the Biden camp at this moment when it comes to the economy is very strong. Yes, that remains the issue that he's dragging right now in the polls, but they have 11 months.
Well, we can discuss this and parse this through. There also has been some new data that has been particularly disinflationary. I'm curious about just President Biden's support on the left, not only when it comes to the Israel-Hamas war, but also with what we're seeing with Ukraine, given the fact that there seems to be a greater willingness on the part of President Biden to give in to certain Republican demands for a border control policy. And this is angering a lot of people. How much do you think he is going to go through with that, even if it does really alienate members of his party?
Well, there's going to have to be a border deal if this administration wants Ukraine aid. Even the most critical defense hawks who are critical of their own party, like Lindsey Graham, say, in order to get Ukraine that money, there has to be a border deal. I'm not sure, though, Biden doesn't want a border deal. He has to walk a fine line, right? He has to make sure that he's listening to the progressives, but at the same time, immigration concerns at the border also rank high in our polling on what swing state voters care about. And Biden may be pushed into that, but it may end up helping him in November.
You mentioned the Politico story on the vice president urging the White House to be more sympathetic to Palestinians. Really difficult question, but go with me. Where's that coming from? In whose interest is it for that story to come out?
Well, I think it partially is interest in Kamala Harris's interest for that story to come out, right? It looks like she's potentially waving the flag for the progressives within the administration. Also last night, some members of the staff, I'm not sure what agency they worked for, whether this was the Executive Office Building, whether this was White House, Commerce, but staffers to this administration were outside the White House protesting President Biden's policy when it comes to Israel. People within the administration, the progressives on the left, think that they have gone too far in their support for Israel when you see a Palestinian death toll north of 17,000 people.
TK, we had a sense that there was division within the White House, division within this government privately. We've seen reports about it. You're now starting to see that publicly in a much more material way.
Yeah, I think the division's there, and in the silence, Lyle Brainerd, who I think owns the phrase cumulative, is the political reality of the Fed babble of yesterday, the shock of it, and I mentioned this late in the show yesterday, what this means for the haves, the elites, the people with assets, which is a much smaller part of America than you can imagine. And the answer is, on the other side of it, to get elected is the agony of inflation. Somebody just sent me in a Bloomberg article on the new egg inflation to come. That's what people care about. Is it a gallon of gas? No. But it's a dozen eggs popping back to $5. Michael Hertzer has that story at Bloomberg News today.
MH, thank you. Anne-Marie, good to see you here in New York. Much more from Anne-Marie throughout the morning on Bloomberg TV and on Bloomberg Radio on that poll. Coming up very shortly, Neil Dutter, Renaissance Macro, and why he's been so right all year. Neil can't wait. He's going to join us in about 5 minutes' time. That was an easy invite, wasn't it, Bram?
Oh, my gosh. Please come
Neil,
to
join us. Come tell us why you've been so right.
Please, we'll listen.
He's going to tell us in about 5 minutes' time. Tune in from New York City this morning. Good morning. Equity futures positive again. The rally continues from New York City. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Pouring fuel on the fire. That was the former New York Fed President Bill Dudley to us yesterday following that Fed decision at Chairman Powell news conference. The fire's still burning. Equity futures on the S&P 500 positive here by 0.25%, 0.25% higher on the S&P 500, up 0.3% on the NASDAQ. Year to date, the gains are more than 20% on the S&P. Year to date, the gains of more than 40%, Lisa, on the NASDAQ.
This, to me, is really the question. How much more fuel is there to burn to really push these to new heights? When do people revise their year-end targets for next year already before next year happens?
The ones that are 2 weeks old.
Yeah, exactly. So they say, okay, well, we already hit those targets. We see no reason for them to go down. This was a shift, a massive shift that is screaming across markets and changes some of the equation going forward for just how much return some people expect to see.
Let's go through the bond market, Lisa, together. 2-year, 10-year. Just sit on the front end just for a moment. So the 2-year on October 19th was 525.71. That was the peak of the cycle, back down to 431.51. On a 10-year, on October 23rd, 5.0187%. We're down to 394.69 and down another 7 basis points this morning.
Yesterday was the biggest rally in the bond market since people were concerned about a banking system collapse in early March. There is a question here now of whether they've gone too far or whether they haven't gone far enough. And what you're seeing in Fed funds futures is 150 basis points of rate cuts priced into the market for next year. That is 6 rate cuts. They say 3, the market says, all right, we'll see that 3 and we'll double it. And this, to me, is a real question. Jay Powell did nothing but to underscore that that was a probability after basically leaning in and saying, well, here we are. We did it.
That right now is the direction of travel. Let's push this through the FX market. Weaker dollar again this morning. The euro against the dollar, 109.24. The ECB coming up a little bit later. At the surveillance this morning, our top story, guess what? It's the Federal Reserve getting ready to reverse the steepest rate hikes in a generation, forecasting a series of cuts next year.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
TK, 2 weeks ago, it was premature to have this conversation. Less than 2 weeks later, it was a topic of discussion.
They're ex post, they're premature, they've seen the data, and I'm going to say it again. Did he have a first look at retail sales this morning, a nominal number? And if it comes in a little bit light, that gets him the cover he needs to do in December what possibly he was going to do in March.
It's TK dabbling in some conspiracy theories.
I don't do this. Full disclosure, I grew up in a house where this was front and center. They spent all day worried about conspiracy theories. I think the way we've been doing it is right. It's out there. People are talking about it. We don't have to believe that there's Vice Chair Biden. Guess what? Some people think there's Vice Chair Biden.
There is a real question of what the difference is between an ideological Federal Reserve chair and one that is much more practical, a pragmatist who doesn't have as much of a sort of academic background. And there is a feeling that he hasn't had a driving theory. So the question is, what is it that he's following when he says data dependency? Let me guess, you agree?
No, I do not agree. I think he had a purple tie on, okay? He was wearing a purple tie yesterday.
Yeah.
That's why he's wearing a purple tie. He's in the middle.
I've got no idea what you're talking about. Just sort of like waving in the wind is what you're suggesting, right? I agree. Okay. All right.
Does Governor Bailey play to the Tories and the Labor? Does he play to them?
Tries not to. Okay. Isn't that the objective? They're meant to be independent, right?
I guess so.
Yeah.
It's a rumor.
I guess so as well. Let's get to the top story. Down in Washington, D.C., House Republicans voting to formally authorize an impeachment inquiry into President Biden. The resolution establishing the investigation's procedures, but does not set a deadline or lay out any specific impeachable offenses. The vote setting up a high-profile clash between Congress and the White House, Lisa, as the 2024 election approaches.
To me, I was reading between the lines, and there are a lot of questions about just how much conviction there is and, frankly, cohesiveness by Republicans against President Biden to actually impeach him, because you've got some Republicans from swing states that are like, well, we don't want to push back against you, but it kind of looks bad for us to really go behind something where there doesn't seem to be much evidence. So here's the question. How much of a stunt is this, and how much can you get some sort of coalescing behind this message?
My book of the summer, a number of impeachment threats ago, a Cass Sunstein little read called Impeachment. It is a tour de force. Doesn't matter, Republican or Democrat. The bastardization of this process is just an absolute travesty. Read Cass Sunstein. He owns the high ground on this.
Don't hold back this morning, TK.
I'm not,
holding back at all,
read Cass Sunstein on impeachment.